Fed has latitude that a lot of places don't have, that they can hold the restrictive and let the economy really catch up.
If financial conditions are easier, then there's less easing for the Fed to do.
They're telling you we want to cut rates. The problem is the data is not letting.
There's no doubt that financial conditions have eased rather dramatically in the course of the past few months.
I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
4 months ago, March 20th was a big deal. This was going to be the day the Federal Reserve was going to reduce interest rates. And here we are, still trying to work out when that's going to happen. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Equity futures a little bit softer on the S&P, coming off a 2-day winning streak on the S&P 500. Lisa, the data disrupting the storytelling of the end of last year.
Which is really what I've read from pretty much every analyst and had in conversations. This is going to be a difficult Fed meeting. And the question is, do they publicly question their assumption of 3 rate cuts at this meeting? And do they publicly allow that maybe rates aren't going to fall as much as they thought in the next couple of years?
So I always say 3-part story. Got to work through a statement, a news conference. In between, I'm going straight to the projections. I'm sure you are as well. Trying to work out whether those two policymakers, because that's all it's going to take, just 2 dots to come up to make the median dot 2 cuts and not 3. And then if that happens, it's up to Chairman Powell in the news conference to kind of shape the agenda, the narrative for financial markets.
So they're the 2 dots versus the 3 dots. Very exciting dot party. Everyone's extremely excited to talk about dots all day long. We will be doing that. Join us for our special. But I am curious also about beyond that. Beyond 2024, what about 2025, 2026? If they start to pull back how far rates can go, how much they can come down, that's going to be a revamp of what we saw in December. That's basically saying our expectations for getting to neutral pretty quickly, I don't know, perhaps a little premature.
I've asked the same question for about a month. Has Chairman Powell gained confidence, lost confidence, or retained confidence since the news conference at the end of January? Based on the data we've had, wouldn't you suggest that he should be losing a little bit of confidence right now? Now, whether he shares that publicly is another story altogether. But ultimately, based on the information, I wouldn't be looking at that and gaining confidence from what I've seen so far.
The market's not gaining confidence. In fact, the market's pushing back rate cuts pretty significantly, and there are an increasing number of analysts saying, wait a second, maybe neutral is 3.5%, maybe it's even 4%. Is the Fed going to address this? Who knows? My guess is it really depends on financial conditions and how worried they are about a stock market that's at record highs, a bond market that's held in even as benchmark rates climb, if they're worried about that or not. To me, the financial conditions question might be the most crucial one to understand their psychology and just how much they think the market's getting away from what they're trying to do.
It's amazing how this is set up. All-time highs on the S&P 500 going into a Fed decision where there is still an obsession about them reducing interest rates. Equity futures right now on the S&P negative by 0.1%. This is what we look like on the S&P and in the bond market as well. In the bond market on a 10-year Treasury at the moment, yields lower by a single basis point, 4.27. Let's call it 4.28. Out of the 4.30s in the last 24 hours, yields dropping away just a touch. In the FX market, dollar absolutely dominant in G10 over the last week, 108.38. And if I can turn briefly to dollar yen, the fact of the matter is this yen is not strengthening, it is weakening. Dollar yen is through 151. Lisa, for a 6th consecutive session, we have had some Japanese yen weakness. We're about to make it day 7.
And we're about to touch the weakest level going back to 1990 versus the dollar. Against the euro, it's at a 16-year low of 164.60. I'm looking at these numbers and trying to figure out, was this what the Bank of Japan wanted? Or does this basically force their hand yet again and say, is this really necessary for you to have such a dovish tone while making a sort of very incremental rate hike to 0? This, to me, is going to be a challenge for them because it imports the wrong kind of inflation.
151.68 on dollar yen. Coming up this hour, lots to discuss. George Concarbis of MUFG expecting a dovish Fed ahead of today's rate decision. Ed Mills of Raymond James on the challenges facing mergers and acquisitions in Washington. And Francis Donald of Manulife seeing growing signs of weakness in the US labor market. We begin with our top story, counting you down to the Fed decision at 2 p.m. Eastern time. George Concarbis of MUFG suggesting it should act before it's too late. We believe the internals of the labor market are not as strong as headlines suggest. The Fed should see through the sticky inflation data and proactively cut before actually seeing a rise in the unemployment rate. George is with us around the table. George, it is fantastic to see you, sir. Let's set things up as follows.
Great to be here.
The difference between what you think they should do and what they will do. We can start with should. Why do you think they should be reducing interest rates right now?
Look, it's always about getting ahead of what lies down the road. And the question is, they have a dual mandate. And it's always been the most challenging thing for the Fed, balancing between full employment and getting inflation under control, which has been their primary focus for the last 2 years. But my concern, our concern in general, is that the longer they wait to at least kind of slowly get us into normalizing rates and then see how the economy is handling it, and we also got fiscal policy behind us, that if they wait too long, they run the risk of a deceleration that really becomes more protracted in the second half.
Let's go back to that quote. You say they should look through the sticky inflation, the hotter than expected reads of the last month or so. Why should they do that?
Because look, the classic thing that we're all concerned about is the wage price spiral. Right? And that's been the case all along. We are concerned that these kind of higher wages or the tightness in the labor market would result in higher inflation. And in fact, a lot of this was supply chain disruptions, energy, and things like that. And so if you are waiting on the wages side, there are signs in the labor market that things are decelerating and wages are also coming down. So like you run this risk that if you wait too long, then you actually start to hurt the jobs market.
Okay, this is the tricky part. And honestly, I spent a lot of time thinking about this. We've been waiting for the slowdown. We've been seeing signs of weakness for a full year now, if not more. People have been waiting for this. And I'm looking right now at the Atlanta Fed wage tracker. It's coming in at about 5%. It's still well above where neutral would suggest. What are you pointing to that gives you conviction that this time is different and that weakness is actually more imminent than, say, 3 years out, 4 years out, when we can see more of an entrenchment of inflation?
Well, I mean, a lot of leading indicators, so for example, the quits rates will lead that wage index. So about 6 months down the road, that wage index can be 3.5 very easily. And then the question, that's still a healthy number, but it's the pace and the deceleration there. And it's the composition of the jobs that we're creating, the part-time versus full-time. And there's been a stalling out of professional services. This has been primarily travel, leisure, hospitality, lower-paying type jobs. And if we don't, if those start to kind of lose pricing power as well, they're the easiest ones to get laid off. And that's the concern. My concern is we're hiring at a very fast pace, but if we miscalculate the landing, those jobs can be gone in a heartbeat.
Why is the balance of risks more important for you to focus on potential weakness in the labor market versus persistent inflation that doesn't seem to be going away?
Because it's a balancing act. That's the whole point of balance of risk, that if you don't get it right, you miscalculate on what happens on the back end of it. And it's going to come down to a judgment call. And this is why, John brings up the great point. It's not what they should do, it's what they will do. And because they got inflation wrong for so long and they were stuck with transitory inflation, and that was the narrative, they're probably going to overstay their welcome in our view, and that's going to cause problems later on.
So should and what you believe? I think what you believe right now from listening to you is that the later they start, the more they're going to have to do further down the road. Listening to the concerns that other people have, and the question that Lisa raises is ultimately the earlier they go, the more likely inflation returns. Which risk do you think wins out on the FOMC at today's meeting and ultimately over the next several months as well?
But here's the thing, though. Does the Fed actually generate inflation? I mean, that's a philosophical question that we have to ask.
Do you think they believe they do?
I think they believe that they influence financial conditions and that they have a strong effect on interest rates, of course. So the question is more about the FCI channel. How quick is it to actually translate into inflation? Because if we start off with concerns around wages, the jobs market is weakening, that's in the background. If you then shift towards FCI, could be fleeting. Markets are at the highs as of yesterday, but are they at the highs 3-6 months down the road? And then that will be disinflationary.
Well, but this really goes to the question of if financial conditions is the transmission mechanism of the Federal Reserve, shouldn't it worry them that their transmission mechanism is malfunctioning if the goal is to bring down inflation?
It's been delayed, and it's been delayed because last year, and still lingering this year, fiscal policy has probably offset 150 to 200 bips of the Fed's actual tightening. That's a pretty powerful move. If you translate the actual quantum of how much government spending we've had in the various government jobs, which also kind of has kept the jobs market stronger than what it seems on the private side, if it wasn't for all of that fiscal, then Fed policy would be much more effective.
Which is the reason why it really shocks me when we get person after person coming on and saying that fiscal is still coming. This morning, we get news of some $20 billion going to an Intel factory. There is so much money still getting poured into the industrial sectors that a lot of people, particularly equity strategists, come on and they say, this is why we're bullish. We see the money and it is still coming. We look at the savings accounts. They are still flush with cash from consumers who are making money. How do you dismiss the fiscal impulse as something that's fleeting when it doesn't seem like it's so fleeting? And frankly, the Fed can't offset that.
Look, it's bifurcated. It's bifurcated within the stock market. You have a very narrow set that's benefiting from this. And it's bifurcated across the U.S. households. The top 20% are basically holding half of the economy up. And so that can work up until it doesn't. I think that's the part. This is like such a sensitive, and we're so at the mercy of financial conditions and like what our valuations are. We're priced to perfection and has a lot of this sort of belief that this money will keep coming in. What if it slows down? I'm a big believer of rate of change. And even though it keeps kind of trickling out, I doubt we beat that bogey from last year. So I think from this point forward, becomes much more of a level playing field on fundamentals between Fed policy versus fiscal policy, and what is the true state of the economy.
We've got to get some yield forecasts from you before you go as well. Can we talk about that? 470 at the front end, there and thereabouts, 430 on a 10-year, and how the Bank of Japan would influence your thinking at the moment. I can see that's exciting you.
Yeah.
What's going on at the BOJ, and why isn't it shaking up markets in a bigger way?
Well, I mean, look, a super well televised, ending up with a dovish hike with a lot of concern that this would be the start of repatriation of money back to Japan, that there was going to be a lack of sponsorship for the U.S. fixed income market. We take the other side, which is that this is, again, because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle, that in reality, this is not that consequential of a move. Now, it is kind of a little bit like chicken and egg, where BOJ almost like needs the Fed to ease now or ease soon, because they'll do a lot of the work for them. But if not, then you have a risk that this 150 numbers is a big deal on the dollar-yen. And if it keeps going, that's why treasuries are rallying. People are realizing that there's going to be a need for U.S. fixed income in Japan.
So your bias is lower yields?
Look, my bias is that market is sometimes too smart for its own good, and we priced in a rate cutting cycle multiple times now, and the Fed has yet to deliver. So it could become, it might end up being very anticlimactic and very similar to the BOJ. The Fed eases, and we're like, oh, it's already priced in. Bonds don't move.
Got it. George, it's good to see you. Really thoughtful. I can't believe it's actually been about 5 years since George has sat around a table with us, which is unbelievable.
And it's wonderful to have him, I've got to say. I love the way that you kind of think through things. And honestly, this is the debate that's underpinning so much of the disagreement on Wall Street right now. And this is the reason why it's so polarized.
I also can't believe that dollar yen is pushing 152, 151.70-ish. George, it's good to see you. Thank you, sir. George Concama's there of MUFG. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. Inflation in the UK falling more sharply than expected, cooling to the lowest level in 2.5 years. The Consumer Prices Index rose 3.4% in February from a year earlier. That's slower than the 4% pace the month before. Economists say the data keeps the Bank of England on track to reduce interest rates later this year. The Texas migrant arrest law is back on hold. Just hours after the law briefly took effect, a federal appeals court stepped in, preventing Texas from arresting and deporting migrants accused of entering the U.S. illegally. A 3-judge panel intervened after a series of back-and-forth court orders that even saw the Supreme Court weigh in. That 3-judge panel meets today. Primary elections were held in Arizona, Florida, Illinois, Kansas, and Ohio yesterday. Former President Donald Trump won all 5 Republican primaries with 75 to 81% support. Meanwhile, President Biden won 4 Democratic primaries after Florida canceled its vote. He received 83 to 91% of the vote. Kansas was the only state with an option for voters to choose none of the above on the Democratic ballot. It took 10%, John. That's your Bloomberg Brief.
Yahara, thank you. Appreciate it. Up next on the program, M&A roadblocks in Washington.
Not everybody has the staying power to fight through, lawsuits and time and effort and things like that. At the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
That conversation up next, live from New York City this morning. Good morning.
The Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
It is Fed decision day. Equity futures on the S&P 500 just about negative by almost 0.1%. No drama there. All-time highs at a close yesterday. Going into this decision a little bit later on this afternoon. Yields a little bit lower. We're down a basis point on a 10-year, 427.68. Under surveillance this morning, M&A roadblocks in Washington.
We need to get this resolved. We need to get a more rational, predictive outcome to have people willing to take the risk of putting their company at risk for a sell side, and that's really what it comes down to. Not everybody has the staying power to fight through lawsuits and time and effort and things like that. At the end of the day, consolidation comes because of strategic import, and I think you have to let capitalism run.
Here's the latest this morning. A number of deals facing pressure in Washington, including tie-ups between Kroger and Albertsons, Capital One and Discover, and US Steel and Nippon. Ed Mills of Raymond James saying, quote, "It should come as no surprise that the Biden administration is putting up roadblocks to M&A. Under a potential Trump presidency, we're likely to see a shift in focus, but the populist politics that have been driving the antitrust DC policies is bipartisan." Ed Mills is with us in the studio here in New York. Ed, I'm so pleased you've made this point because I think it's really important. Just how much distance is there between the two parties right now on this issue?
Well, when we look back to look at Lina Khan, when she was confirmed by the Senate, it was overwhelmingly bipartisan. And she's the head of the FTC, the big antitrust regulator in D.C. The only thing that Republicans didn't like is that she was put in charge as chair. When we look at Donald Trump, he ran as a populist. We have large antitrust activity in this country when we have major technological change, major income inequality, and when there's populist politics. That's not going to change with this election. The focus will shift. It might become more transactional, more kind of specific to kind of what maybe a Donald Trump likes or dislikes, but it's not an all clear after the election if Donald Trump is elected.
The language both sides use is different, but ultimately the state is getting bigger and not smaller. Is anyone arguing for small government in Washington, D.C. anymore?
No. I think what we are looking at is kind of where, when you are in charge, you want to push your priorities. And so what we've said on antitrust as well is that we've had a seismic shift at a glacial pace. And what we're seeing with a lot of these deals is that the approval process is part of that glacial pace, because getting anything done and getting folks to the table being willing to put their companies at risk for that approval process is getting harder and harder.
Not to get too philosophical, but what's the new form of American capitalism at a time where you've got antitrust issues getting enforced, deals that aren't getting through, and then you're getting tons of money being poured into the new national champions, whether it's electric vehicle policies or whether it's some of these loans and other grants to the likes of Intel because of some of the concerns around security?
Yeah, Lisa, what we said is that the new kind of change in policy is that technology is a national security asset. So we should look at some of the government funding for technology similar to a defense budget. We are trying to rebuild our industrial base in the United States. That was what was behind the Inflation Reduction Act. That was behind the Chips and Science Act. That was behind the bipartisan infrastructure bill. And so the dollar amount that governments are willing to put into different sectors and into different companies is all national security driven. Even on electric vehicles, we have fought wars for a generation in the Middle East over access to oil. A lot of policymakers in D.C. say if we shift to an electric economy, we need to make sure that electric components in the EV batteries are made here in the United States versus in a geopolitically vulnerable space. The fact that Taiwan has the leading semiconductors, that's a very geographically and geopolitically vulnerable space. So investing in that is an investment in the defense budget and rebuilds the industrial base of the United States.
George Goncalves of MUFG was just on, and he was saying that he expects fiscal spending to stop. With central planning that's trying to pick national winners, how can fiscal spending stop? Doesn't it have to continue to support some of these industries?
Yeah, I'd be on the side of the disagreement. When we started this Congress after Republicans won a majority in the House of Representatives, everyone thought we'd get cuts. We are on the verge of finally passing kind of the appropriations bills for this year. We're going to have flat for domestic, 3% up on defense. We still could do a defense supplemental. We have all of those bills that I've talked about just hitting the economy. And on the Chips and Science Act, we got awards for Intel. That's not exactly what they want. They want more. And so you're going to have a push for a CHIPS Act 2.0. The spigot is on in D.C., and that's supporting the economy, and I think is very much supporting a soft landing or no landing from an economics perspective.
It's amazing some of the numbers involved. Ed, can we talk about how we got here, what this is in response to. And some people might argue that maybe it was in response to China and Made in China 2025 over the last decade, which was pretty bold and I would say even brazen, coming out and just saying these are the industries we're going to dominate. And as some commentators have talked about recently, they might have stopped talking about Made in China 2025, but they carried on executing the plan. I've always looked at this situation and reflected on how we used to look at things 10, 20 years ago, where people in the West, and I've said arrogantly and mistakenly, believed that China would become more like us in the West. And it sounds like listening to you that we're becoming more like China. And it's going to look more and more like China in the years to come. Now, I'm not saying that Washington, D.C. is turning into the CCP. Some of you might think they are.
I'm
not saying that this morning.
Yes,
I'm not saying that. But I am saying we're going down a path that we didn't think we'd be going down, are we?
Well, I think it's more eyes wide open as it relates to China. I always talk about the fact that for years, one of the conversations in D.C. was that you had to treat China in a certain way, that if you cause embarrassment, if they lost face, that was the worst case scenario. And now we have policy that, essentially punches them in the face. And they're still talking to us. So the conversation in D.C. has changed, and that posture towards D.C. is, the posture towards China has changed. You talk about China 2025. What folks in the Defense Department and people that I talked to were focused on was, China 2027, which is when they want to have the military capability of an attack on Taiwan if they wanted to. And all of these tech restrictions were trying to push back that timeline, not giving them the semiconductors, not giving them the artificial intelligence that is necessary to, pull off that attack if they wanted to do that. We don't think that they are near that, but it is all about national security. What are the areas that we still control as the United States government and as our technological leadership here in the United States? And what can we do to slow down China and what they want to do?
To John's point, though, is fighting China becoming China? Is that essentially what we're seeing with some of the more focus on national champions and central planning?
So I think we do it very differently. We don't have state-owned enterprises. There's still a huge focus in Washington, D.C., and part of the delay between the passage of the CHIPS Act and the passage of the IRA in getting this money out is making sure that there's some level of support for what's being done. They are prioritizing projects that actually can happen. Back in the Obama administration, when there was the stimulus bill that subsidized solar, and there was a lot of blowups there, that has changed the policy. We'll see if it's right this time, but there's at least a focus on what are the projects that actually can get done and actually be successful. Hit project goals by 2030 is a key component of what the Commerce Department is doing. So they get blamed for taking longer, but hopefully they're doing it right.
I'm thinking of one industry where the market is pushing back against the state quite aggressively, and that seems to be the auto industry right now. How do you see that turning out in the next couple of years? EVs just aren't taking off in the way this administration would like them to. What can they do about that?
So I think what we're focused on with the auto industry is kind of the fact that Michigan is one of the key states. Whoever wins Michigan probably is president. And so you had an unprecedented act by President Biden showing up on a picket line for the auto workers. I think that the next thing that we're going to see is an aggressive fight against Chinese-made cars and where they're going in the world. That's the next trade fight that is coming here. We're going to see a focus not on EVs necessarily from China, but there's a lot of excess capacity that is in China on internal combustion engines, the ICE vehicles. Where they are going to flood the market? Is that going to be a challenge to Detroit? That's what you're going to see in D.C. as a huge fight for the industry.
Fascinating. That fight picked up big time over the weekend with threats of 100% tariffs on Chinese EVs made in Mexico. Ed, it's great to see you. Likewise. Want to do this again. Thank you, sir. Ed Mills there of Raymond James. Coming up on this program, Win Thin of Brown Brothers Harriman on a stronger dollar and a much weaker Japanese yen. That's next. This is Bloomberg. Two-day winning streak on the S&P 500. Futures a little bit softer. We're negative 0.1%, coming off the back of all-time highs at a close going into the Federal Reserve decision later on this afternoon. Nasdaq futures going absolutely nowhere. Switch at the board In the bond market, 2-year, 10-year, 30-year, yields dropping for the first time in about a week. More than a week on a 2-year and a 10-year yesterday. We're down a basis point this morning, 428, backing away from the 430s. Still pretty close to the highs of the year. The highs of 2024 on a 2-year yield. We're down about a basis point, Lisa, 467.67.
Which raises this question, where is the asymmetry of risks today at the press conference with the Federal Reserve? Is it a potential sell-off with yields going materially higher, or is it some sort of piling in as people realize this Fed really does want to hike? I think Cabana yesterday, Mark Cabana of Bank of America, really put it well. And he basically said, if they move from 3 dots to 2 dots, it's going to be super exciting, and you're going to see a sell-off with 10-year yields rising, I think, something like 10 basis points.
His point on the equity market, though, what is the equity market telling the bond market? Let's reframe this. Not what is the bond market telling stocks, but what are stocks telling bonds?
That they probably need to be pricing in a hotter economy. And this is really where the bond market, the collective wisdom of crowds, if you believe in that, is telling the Fed, your job is not done. And we're concerned that maybe inflation could be running for hotter and for longer, which is the reason why I wonder if the balance of risks for them really is to preserve some sort of sense there are going to be 3 rate cuts and that we prioritize the labor market ahead of the potential resurgence in inflation.
Let's get to the wisdom of foreign exchange. Dollar, absolutely dominant. 5 days of dollar strength. Longest streak going back to about September. Dollar yen. 7-day run of Japanese yen weakness. Dollar yen 151.72. Lisa, getting closer and closer to 152.
Which would be some of the weakest levels we've seen going back to 1990. Is this what the Bank of Japan wanted? I mean, you have to wonder at what point they start to rethink the dovish tilt to an otherwise just superficial rate hike, considering the fact that they telegraphed it perfectly. I don't know the answer, but they got to be getting a little bit concerned.
Big time. Winthin joining us in just a moment to talk about some of this. 151.71 on dollar yen. Under surveillance this morning. Top story, the Fed rate decision due out at 2 p.m. Eastern, with Fed Chair Jay Powell set to speak at 2:30. Rates are expected to remain on hold, but the FOMC will release a new dot plot and summary of economic projections. Bloomberg Economics still expecting 3 cuts this year, with a dovish Chair Powell, despite a string of hotter than expected inflation prints since the last meeting. As Lisa mentioned, if you've been missing the coverage over the last week on that dot plot, it will only take 2 officials at the Federal Reserve to come up. And ultimately, that's going to change the median dot from 3 cuts this year to 2. Is that a big deal, given the direction of travel over the last few months?
Well, okay, we're talking about 8 of 19 Fed officials. This is where we're at, because this is how closely people are scrutinizing this, that already had 2 rate cuts being priced in rather than 3. If 2 more join that, then all of a sudden you have the baseline. To me, I'm actually more interested in the longer run. How they telegraph the longer-term inflation expectation and longer-term rate expectation for 2025, 2026. Do they expect not neutral getting a little higher, but them not being able to cut as much longer term? That could actually have a really significant impact.
Do you think they'll even entertain that today in the news conference?
Not the neutral rate, because why open that can of worms? But they have the SEP, the Statement of Economic Projections, and they have to reassess whether the downgrade to their rate forecasts back in December really was appropriate or whether it was premature.
Whether they entertain the prospect of reducing interest rates maybe a little bit too soon as well?
Perhaps. The market's certainly saying that, but also that they're not going to be able to cut nearly as much because the year-over-year comps don't make it as easy for them come at the beginning of next year.
Inflation, a little bit hotter to start 2024. Let's turn to luxury names in Europe. Absolutely plunging. Kering warning that Gucci sales have dropped 20% in the Asia-Pacific region during the first quarter. The luxury group is attempting to revitalise the Gucci brand that accounts for about 2/3 of the company's profit. The drop is set to wipe out approximately $7.6 billion in market value. The slump also weighing on competitors like LVMH, as luxury sales in China have cooled over the past year. Now, Gucci has its own problems, Bramo, but when a company comes out and says sales are down 20% in the Asia-Pacific region, I think that's why the likes of LVMH are spooked this morning.
Gucci is more hinged to the Chinese consumer. I was finding out all sorts of things about their China connection last night as I was looking at this and wondering, okay, how isolated are they? And how much is this a Gucci problem? And how much is this a Chinese consumer problem? How much is this sort of the nationalist bent and people kind of trying to stay close to home and buying their stuff there versus really just not having the means to go out and spend? I don't know the answer. I love the idea Gucci has stealth wealth products.
They're trying.
They're trying.
They're trying to move from loud luxury to quiet luxury. Good luck.
Yeah, well, I mean, Gucci's known for loud luxury, isn't it? Sort of
it's the brand in the G's, yeah.
I mean, that's the whole thing, right?
The big belt buckles.
The whole thing. And so if people don't want that, are they really going to migrate to, you know, what someone else might wear?
Brunello.
Yeah.
Something like that. People who can afford Brunello. Carrying down by 12.8%. at the moment over in Europe. Gucci's got problems. We need TK here because TK is the luxury expert, and he would tell you that Gucci's had problems now for a while.
Gucci definitely is more of the realm of Tom Keene than Lisa Abramowicz, but I will.
TK,
yes,
big
we should
time
call
on
in
Gucci.
from wherever you are.
I spoke to him yesterday.
Yeah.
Funny enough, he'd just been to Dior as he was on the phone to me. I'll share more a little bit later. Let's finish on this story.
On brand.
Yeah, sure. The FAA ramping up pressure on Boeing in an interview with NBC News. FAA Administrator Michael Whitaker saying the jet maker has no other option. Quote, they need to make safe airplanes or they will be capped at a production level that's not sustainable. So I'm confident that they'll get there. Last month, Boeing was given 90 days to develop a plan to improve its culture and practices after a series of mishaps, including a panel flying off a 737 MAX jet mid-flight. Boeing has previously said it's focused on taking action with transparency at every turn. The more transparency we get, the worse it looks.
There are no proposed solutions. We just hear it seems like they prioritized production over safety. You don't want to hear that. That's not helpful to the cause. You just wonder, again, where's the bottom and when do we find out what that actually means in terms of the steps they can take to change something?
Boeing down again in the pre-market a little bit earlier this morning. Let's turn to foreign exchange. The US dollar gaining ahead of today's Fed decision and a hike from the Bank of Japan yesterday. Winthin of Brown Brothers Harriman expecting the dollar rally to continue. Current market easing expectations for the Fed still need to adjust. When they do, the dollar should gain even further. Wynn, I'm pleased to say, joins us now. Wynn, let's start in the FX market with Japanese yen, if we can. Dollar yen breaking out towards 152, even with the first interest rate hike in 17 years. We've got to go all the way back to 2007. When can you tell us and our audience what you think is developing in Japan?
Sure. First of all, thanks for having me. It's been a while, and it's always a pleasure to be on this show. Look, I think the Bank of Japan really put off this liftoff for so long just because the previous times they tried to hike, they'd gone back into recession. So I can't blame Mr. Ueda and company for being cautious, but at this point, it seems they have engineered a successful exit. And by successful, I mean that inflation is around 2%, give or take. But more importantly, they've really been able to avoid any sort of disruptive moves in the markets. And that by disruptive to me would be a much stronger yen and sharply higher JGB yields, both of which would be very negative for Japan. So with all the job owning and the leaks and what have you, I really tip my hat to them. They've avoided for now a sort of disruptive, unwanted moves. Now, are they crazy about continued yen weakness? Probably not. But if they had to take a little weaker yen over a little stronger yen, they'd probably take a little bit weaker one. And I think they can maintain they can intervene and sort of help maintain stable FX markets. And that's what I think is being seen right now and will be seen for the time being.
We just need to pick up on some of those words. One is stable. What's stable about the Japanese yen at the moment? Why do you think this wouldn't concern them, this shift towards 152?
Sure. So look, we've been sort of gyrating around 150 really for the last several months, if not quarters. We haven't had huge moves really since I think the end of 2022 when the Bank of Japan last intervened. So look, if we start creeping up towards 155, yeah, I think they will start. Of course, the job owning comes first, but I would not rule out intervention. It's something that I think they're willing and able to undertake. And again, we right now the market is pricing in a very dovish Bank of Japan. That's part of the forward guidance that they provided. They said that the policy has to still remain accommodative for quite some time. So if you look at the swaps market, it's only pricing in about 50 basis points over the next 2 years, which seems a little low to me. But that's what the market's going with. Of course, the Bank of Japan could sort of change its forward guidance, sort of nudge that up a little bit and help put some air under the yen. But again, they've been dealing with the weak yen for quite a while now. So yes, I would say the yellow lights are blinking, but I don't think it's sort of like, I guess, really alarming at this point.
There is this issue, though, about the Federal Reserve and the meeting today and how much a hawkish tilt could really turbocharge the sell-off in the yen. What do you think? I mean, how high is the bar for that type of more protracted move?
Yeah, so the one reason I think part of it was luck that the Bank of Japan has avoided this sort of disruptive move because the liftoff came at a time when the dollar was strong. So we didn't see a huge jump in the yen. Many people were looking for 125, 135 in dollar yen. We're just not seeing that for a variety of reasons. But yeah, it's not a yen story, though, at this point. It's really a dollar story. The dollar is just, the U.S. economy remains head and shoulders above everyone else. The dollar remains supported by high interest rates. Lisa and Jonathan, you're talking about Fed expectations. Yeah, I think it's higher for longer. I do think that we could get a hawkish shift in the dot plots, whether it's in 2024, 25. I'm not sure, but if you look at the December plots, the Fed officials are penciling 175 basis points of cuts through the end of 2025. And given how strong the U.S. economy is, that seems overdone. I think most of the market has bought into the soft landing story, which would require maybe a couple of insurance cuts. But 175 seems very aggressive. So I think there's room for this sort of hawkish surprise. I would say the only warning I have is always, I never underestimate Chair Powell's propensity to surprise the market with some sort of dovish remark during the press conference. So that's why I'm always sort of hedge my bets.
Which is the reason why maybe people have been a little bit more bearish in the dollar than maybe they otherwise should have. I don't know. You can attribute whatever you want, but the positioning has been such that people are prepared for a greenback that is weakening, not strengthening materially. So how offside could some of those trades be if we do get a hawkish tilt that actually maintains through a press conference with Jay Powell?
Yeah, so let's go back to the beginning of 2023 and also the beginning of 2024. Both sort of consensus calls were for a weaker dollar, whether it's because of a U.S. recession, which is not happening, or a soft landing. Either way, it's all predicated upon a very dovish Fed. And we just haven't seen it. Remember, at the start of the year, I think the market was pricing in 150 basis points of cuts through this year alone, starting in March. And look, here we are just barely 2 months later, and that call has been colossally wrong. So I still think that sort of repricing still has room to go. I'm one of the latecomers to the soft landing. I've always been skeptical, but I think it's happening. It's happened maybe once or twice in my lifetime, my career, I guess I would say. So it's like a unicorn. It's very rare, but I think we're seeing it unfold. And again, if this does prove to be the case, 175 basis points of rate cuts by end of next year just seems too much. And I think today will be very key. But it all depends on the dollar, on the data, excuse me. The data remain firm. The labor market remains strong. We're seeing some signs of softening, but not enough to get us concerned. So for now, it's steady as she goes. I like the dollar higher. I think Europe has its problems. Japan is, I think one of the reasons that the Bank of Japan has been so cautious is that Japan economy has hit a soft patch. You mentioned China. Awful stuff coming out of China. So really, the U.S. is the driver of global growth right now. And I think that's why the dollar remains so attractive.
Hey, Win, great to catch up with you. Thoughtful stuff. Win Thin there of Brown Brothers Harriman. Dollar stronger for a fifth consecutive session. Just to take a step back, and I'm pleased Win did this and framed it in the following way. We did the same thing about 40 minutes ago. This March meeting is a very different March meeting to the one that people expected about 3-4 months ago.
This is going to be one that has to address data that has not cooperated, that has not given them more comfort, and a market that's moved away from the Fed, even though it's adapting to what the Fed projected back in December. It's accelerating past that and suggesting maybe the paradigm has shifted.
At 2 p.m. Eastern Time, the Fed decision later on this afternoon. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahira Hackes. Hey, Yahira.
Hi, John. The ECB is likely to cut rates in June, according to President Christine Lagarde. But beyond that, she said they're not able to commit to a future path. Speaking in Frankfurt this morning, Lagarde saying, quote, our decisions will have to remain data dependent and meeting by meeting, responding to new information as it comes in. Samsung shares posted their biggest gain in more than 6 months after a backing by NVIDIA. CEO Jensen Huang reportedly said he plans to use Samsung as a supplier of high-bandwidth memory chips. NVIDIA unveiled its next generation of AI hardware called Blackwell at its much-anticipated conference in California earlier this week. Intel is in line to receive nearly $20 billion in grants and loans from the U.S. to build semiconductor plants. This marks the largest award yet in an effort by the White House to bring chips manufacturing back to America. The award comes amid an ambitious turnaround plan for the company under CEO Pat Gelsinger. That's your Bloomberg brief. John?
Yahira, thank you. Appreciate it. Intel up by a little more than 3% this morning. Up next on this program, decision day for the Fed.
Rates at some point should move lower. The lack of confidence is about when does the window open.
If you can't justify a cut by June, you might not have a leg to stand on to start cutting until early next year.
That conversation up next with the brilliant Francis Donald of Manulife from New York City. This is Bloomberg. Live from New York City. Welcome to the program. The S&P 500 slightly softer, no drama at all. We're not even lower by 0.1%. Yields are down a single basis point, just backing away a little bit from the highs of the year. 427.48 on a US 10-year. Under surveillance this morning, decision day for the Fed.
Rates at some point should move lower. The lack of confidence is about when does the window open? When does the data tell them, okay, it's fine to start? So I think there's a little uncertainty about when to start, but I think the confidence in the overall disinflation trend is there.
If you can't justify a cut by June, given that the base effects will be a lot less favorable for the rest of the year, you might not have a leg to stand on to start cutting until early next year. So that might be a reason to just get going now unless you're really comfortable starting next March.
Here's the latest this morning. The Fed rate decision coming at 2 p.m. Eastern Time. Bloomberg Economics expecting the Fed to hold rates steady, but predicting 75 basis points of rate cuts this year. Francis Donald of Manulife writing this. We think the Fed has to get back to neutral by the end of 2025, but credible shops range from 1.5% to 4% over that time frame. And the dispersion of forecasts is way more important than whether the first cut is in June or September. Francis, I'm pleased to say, is with us around the table. Francis, good morning to you.
Good morning.
I want to go to something you talked about at the start of the year, and you said, pick your poison. Either the data accelerates and we lose rate cuts, or the data worsens and we have to reconsider the soft landing. Are we on track in terms of what you were looking for in 24?
Yeah, that's right. So when we wrote that, our view was, well, first, one of those things is going to happen, which is the data is just not going to soften. The inflation is not going to come down enough. We're going to have to price out what was at the time almost 6 rate cuts, go down to around 3. And then later this year, it's the second part of that, which is we still believe that the data is going to deteriorate in such a way where we end up with later rate cuts, but faster rate cuts as the soft landing narrative starts to disperse. But we still have a few more months ahead of that. So 2 things can be true at the same time. We can still believe that recession risk is higher than what is currently priced, but that it's not quite time to trade that story yet.
What do you think will influence the Fed the most? What has happened or what they anticipate will happen based on what you've just said?
I don't know, because it's not clear what the decision-making function at the Federal Reserve is right now. So what I'm looking for today is give me your numbers. Tell me the data you're looking at. Are you looking at super core inflation, which is way too hot, 3.8%? Or are you playing with numbers? Because we can all do that. Can you do a CPI ex-shelter 6 months annualized and get down to 1.8? Which one do you want to use? Because there's all manner of data to argue in any direction right now. I can make a case for the doves or the hawks. What I want to know is what case is Powell going to build?
And it probably, people are expecting, as Winthin was just pointing out, that dovish hiccup that always happens in the press conference, which maybe is how people are positioning. I am curious, though, sort of piggybacking on the George Concalves conversation, the asymmetry of risks and why some people think it is important to cut rates now because the downside is nonlinear and can happen very quickly. What's your view on that?
This is what worries me. So we are going through forecast review, as most economists do, every few months, and we see the data flirting around 0%. So slightly below, slightly above, depending on how the consumer moves. But there's 2 things that keep me up at night. And one of them is that the average time from the first rate hike to its full impact on the economy is 2 years. That's today. So the window for these challenges, for recession calls to close, is not behind us. It's actually ahead of us. That's number one. But the second is exactly this nonlinearity. When things break in the economy, particularly the U.S. economy, they don't break slowly and they don't break in straight lines. So some of the weakness that we're seeing in the job market is just worth keeping our eye on. Rehiring activity is down quite a bit. There's a significant amount of survey data saying we're not as excited about jobs. And yes, there's still 2 million job openings relative to amount of workers looking for jobs. But when I start to see a little bit of softness in labor, there's a part in the back of my mind that says when this breaks, it won't be slow and steady.
I am going to say it. Is this time different? Simply because the fiscal spigots are on and they are pumping up against all of some of the restriction that the Fed is trying to put in the market.
Yeah, fiscal is a huge part of this story and has complicated the last few years, no question. Pro-cyclical fiscal spending is not part of the Economist Handbook. We did not learn that in our textbooks when we went to school. And of course, labor shortages and the entirely new supply-side driven world, which makes inflation and growth less interest rate sensitive. These are all things that are different. But maybe I'm old-fashioned I just cannot get away from the idea that when money costs more, you borrow less. When you lose your job, you don't spend as much money. These are truisms that I think will still persist. And therefore, we end up in a situation where I have mollified or reduced the impact of rate hikes in my forecast, but I cannot escape the idea that there are some things that will always be true. And higher rates slow economies.
You wear two hats. Can we talk about the other hat as well at the same time? Markets are at all-time highs. Does that influence any of the thinking of the Federal Reserve at all?
Well, back in the fall, you might remember Chair Powell was all about financial conditions. And then when he pivoted in December, those didn't seem to matter as much anymore. So I'm looking for two things today. One is Chair Powell going to talk about financial conditions? How does he see that? And the second is I want to know what their 2025 and 2026 outlook looks like, because there is so much focus on 2-3 hikes this year. For most of my clients, for most of our funds, 2 or 3, June or September is not going to be a difference. What makes a big difference is this a 1995 easing cycle with just a few little sprinkled in, or are we going for 200, 300 basis points? And 2025, 2026 is going to be much more important for most asset allocation decisions than some of the minutia around sort of when do they start.
Steve Rashid of Mizuho sat just to the right of me in the last week, and he talked about how this Federal Reserve wants to cut interest rates. And just listening to you, I don't want to imply how you feel, I'm just going to tell you how it sounds. Do you think Chairman Powell is constantly just moving the goalposts because he wants to reduce interest rates? Is that what you think is going on at the Fed?
Entirely possible, because we all have the same data. They would also be aware of things like labor markets don't break linearly, and there are higher rates that hurt the economy. So if they want to bring down real rates and they want to stick a landing, then they probably have to start sooner than later. But here's the elephant in the room. Inflation has been uncomfortable the last 2 months. It looks like if commodity prices don't decline, we're not going to get the next wave down unless you see weakness in the job market. So I think what really worries him is, does he have to go back to where he was at Jackson Hole in 2022 and say, I actually have to break the labor market in order to get inflation back down to 2%? Or do I really want to try to stick the landing? And I think it's this bias within him. Is he okay to allow a recession or not? That is probably more important than does he want to or does he not want to?
So Francis, put all this together. Do you buy stocks?
I think you buy select stocks and you speak to your equity stock pickers who can find good companies that navigate this type of environment. On balance, I like fixed income much more in this market. I got to say, a lot of people talking about the Bank of Japan. Why was it significant? Well, the bulk of my career has been trying to convince people that fixed income is an important part of your allocation. And that was really difficult in a negative rates environment. Now we're at a tipping point where you can actually see the benefits of fixed income, both in terms of potential price returns and also income returns. So that story's become much more interesting to me.
If the yen weakens significantly, do you see a lot of Japanese buyers flooding back into the U.S. credit market?
Sure, it's entirely a possibility, but credit also makes me just a little bit nervous as we head into what I still think is very high recession risk.
Credit spreads are tight, stocks are at all-time highs. It's a pretty fascinating Fed decision, and very different. We've said this repeatedly through this hour. Very different to the Fed decision we thought we'd get 3-4 months ago, when March was like the date. That was the spot. They were going to reduce interest rates. Do you remember that?
Well, I remember it because I couldn't figure out why March was the date when the data wasn't going to deteriorate and we weren't going to see enough inflation moving downwards. But here's the point. If you look back over history, whenever the Fed has paused or pivot, we've seen a significant amount of volatility in fixed income around that time. So big bets at this moment historically have not been a great idea. Move incrementally, but most importantly, we got to know what the Fed's decision-making function is. You can build your own. You can go to like Build-A-Bear, build a function for the Federal Reserve.
Sure.
But we got to know what he's watching. And today, the most important thing is give me some data points, give me some insight into that, and then we can build out a better forecast for the Fed for the rest of this year.
We're not asking for much, Jay, if you're waking up down in DC. Not asking for much at all. Francis, thank you. This was brilliant. Francis Donald there of Manulife. Just to set up the second hour of Bloomberg Surveillance, Wade Lee of BlackRock, Greg Peters of PGIM, Michael Shepard of Bloomberg News, Nadia Martin-Wigan of Svelland Capital on the commodity market, and that breakout we've seen in crude recently, Bramo, that Francis just mentioned.
I'm going to go home today. I'm going to say we're not building a bear. We're going to build a Fed function. And the kids are going to be so excited.
Oh, yeah,
like,
thrilled.
yes, I can't wait
But
to
maybe
build.
they're too old now to build bears.
They
might be more interested in
Yeah.
building Fed models.
Maybe. I'll check
Or
with
not.
them. I'll report back tomorrow.
From New York City, this is Bloomberg.
The
Fed's real focus is going to be what do they want to do with the overall setting of interest rate policy? How long do they want to keep rates at current levels? Those are the big questions that they have to ask right now.
We know that March is off the table. May is probably off the table too. We're really talking about what, Fed cutting rates probably sometime this summer.
And the median stays at 3 cuts. When do you deliver those? You don't need to deliver them now.
For the Fed here, I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
The baseline remains 2 to 3 cuts this year starting in June, and the data is consistent with that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This year has already turned a lot of calls upside down. Like from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with equities just a touch softer on the S&P 500, coming into Wednesday at all-time highs, going into a Fed decision with credit spreads very, very tight and yields just off the highs for 2024 on a 2-year and on a 10-year as well. Lisa, we just caught up with Frances Donald of Manulife, and she put it pretty bluntly. Chairman Powell, tell us what you're looking at and how it's guiding you to this big call.
Data dependency we've been griping about for quite a while, and rightly so, because essentially, which data are they watching? Are we going to be focusing on the University of Michigan sentiment survey and 5 to 10-year inflation expectations, or are we going to be focusing on JOLTS and quit numbers? Honestly, which data are they going to massage to give a view that could be dovish or hawkish, depending on the person who's
And how dependable is that economic data as well? Think about the payrolls report that came out for the month of January. Huge, big revision. You look at February, you start to look at the labour market maybe in different ways. PPI's coming hot, CPI's coming hot. Then you could pick your basket of goods and services and basically tell whatever story you want to tell. What is the bias of this Federal Reserve? And is Steve Rasciuto of Mizuho correct that this Fed wants to cut and is going to do everything it can to reduce interest rates?
Can they, at this point, though, justify it, given the fact that we've seen hot print after hot print when it comes to inflation? That's why people are watching, and Francis put this really well in terms of not just whether it's 2 or 3 dots. 3 dots is what they had in the previous projection. If they move it down to 2 rate cuts for this year, that indicates a sort of more hawkish tone, but also 2025, 2026. Are they seeing their ability to cut rates that significantly materially crimped by the fact that inflation is stickier than they previously expected?
2 challenges. 1, got to try and call the Fed. 2, got to work out what the market's going to do in response to that. And 1, if you'd called things correctly so far this year, I'm not sure you would have got 2, with equities still grinding higher, surging, rallying towards all-time highs, even as we price out Federal Reserve interest rate cuts. And another great example of that, 1, call on a central bank, and then 2, getting the market call right. Bank of Japan, if you made the call this year, we'd get the first interest rate hike from the BOJ since 2007. Would you have the Japanese yen as the worst performing currency in G10 against the US dollar this year? I'm going to guess probably not.
Potentially the weakest going back to 1990 versus the dollar, and in 16 years versus the euro. You take a look at the weakness in the yen. Is it a function of Japan and sort of the dovish message, or is it a function, again, what we heard from Win Thin, of King Dollar and this idea that the U.S. strength has been exceptional and keeps outperforming? To your point about getting a market call right, the narratives are mind-spinning. Do you listen to Jay Powell or do you listen to Jensen Huang? And ultimately, this is the 2 polar sort of aspects of this market. Do you focus on technological advancements? Do you focus on fiscal spending? Or do you focus on a Federal Reserve that's playing catch-up with all these metrics that aren't cooperating with them?
I'd say the last 12 months, better off following Jensen than Jay over the last year, based on what Nvidia's done in the stock market. Dollar yen right now, 7 days of weakness. Dollar yen very close to 152. The broader price action elsewhere, equities on the S&P 500 just about unchanged and going nowhere. Exactly. Precisely unchanged right now. Yields are down a basis point on a 10-year, 427.68. In foreign exchange, the dollar stronger against almost everything in G10 through much of this morning and over the last year as well, year to date. Euro dollar 108.43. Coming up this hour, Wei Li of BlackRock on why she sees rates staying higher for longer than pre-pandemic. Greg Peters of PGM on why he thinks this is a strategic buying zone for bonds. And Nadia Martin-Wigan of Svelland Capital as Brent touches the highest level going all the way back to October. We begin with our top story. 2 days of gains sending the S&P 500 back to another all-time high ahead of today's Fed decision. Wei Li of BlackRock writes in this: we think upbeat sentiment can persist as inflation keeps falling. We stay overweight US stocks and lean into the AI theme as tech drives corporate earnings growth. We see Fed policy rates staying higher than before the pandemic as inflation likely settles closer to 3%. Wei Li, I'm pleased to say, is with us now. Wei, I want to go straight to that inflation call and go back to what you told us at the start start of the year, where essentially what you were looking for was inflation to come down a little bit more, then pick back up towards the end of the year. Are we seeing that pickup maybe ahead of schedule?
That's possible, but I would note that the 2 consecutive months of inflation upside surprises came from different sources. So the January bumper print was mostly because of core service, and the February print was driven by hotter than expected goods inflationary pressure. So I think the jury is still out there in terms of if we are seeing the trough of this inflation roller coaster. Our view is that actually there is room for goods deflation to bring inflation down further. But when that runs its course, which is more likely later this year rather than now, service starts to dominate. And that's when wage pressure pushes inflation higher. And ultimately, we're looking at the trend settling around 3% rather than 2%. But that roller coaster is for later this year rather than right now. And right now, I think the bar is pretty high for markets to abandon this narrative of immaculate disinflation, which is why we're positive on risk sentiment and we're positive on U.S. equities at this moment.
Before we get deeper into equity markets, Wei, how do you think that's going to influence the thinking of Chairman Powell in today's news conference?
Well, it's likely going to be a very balanced press conference and very balanced FOMC. They will emphasize data dependency. They will try to strike a balanced tone. You know, the last meeting, they talked about a sticky last mile. So I am very curious in terms of how they speak to the recent upside surprises in inflation prints. I'm also curious in terms of if they're going to revise growth higher, inflation higher. They're going to start discussing the Fed balance sheet runoff, maybe trimming that a little bit. So lots of things at play. But more broadly speaking, we are expecting dot median to stay at 3 cuts for this year, which is in line with our expectation at the beginning of the year. So now markets finally moving closer to that.
Before shifting to stocks, what duration of bonds do you feel is most vulnerable, given where pricing is and given what you expect to transpire with inflation later this year?
While we have a preference for short end of the curve and also the belly of the curve. So implicitly, there is a steepening view over the longer term. And that is more of a fiscal story, right? So if you look at the fiscal deficit in the US, late 2022, we're looking at 3.5%. And now we're getting to 8%, and debt servicing cost is increasing, expected to increase even more, the higher rates for longer, and term premium needing to come back. So all of that points to higher rates, especially for long end of the curve. But when that kicks in, when that repricing because of concern around fiscal dynamics and debt serviceability, that's key, which is why our conviction on the long end of the curve, yields moving higher, it's stronger over a strategic horizon than over a tactical horizon of 6 to 12 months.
Are stocks vulnerable to a hawkish surprise from the Fed, or are they operating according to a different set of rules that really hinge on very different factors than Fed set rates?
But you asked the question, Jay versus Jensen. So I think that's what stock markets are trying to figure out as well. But if year to date is anything to go by, we have had hawkish repricing of the Fed, like 7 cuts at the beginning of the year to now just 3 cuts. And yet markets are very resilient. S&P is up close to 9%, equal weighted S&P close to 5%, right? So this is not a market that are caving in under hawkish repricing pressure, and the bridging factor, the reconciliatory factor here is the strong earnings, and a lot of the earnings are being heavy lifted by the AI theme, which is why we are positive on U.S. equity market, because earnings are coming in strong and stronger, beating expectation, and we lean into AI because that's where actually most of the earnings momentum is coming from.
Given that way, do you think that calls for some sort of broadening out in the rally are premature, just simply because the gains still are concentrated, not just with magnificent 4, 3, or 2, or whatever people have whittled it down to, but also only the companies that are most leveraged to immediate benefits from some of this technology?
Well, I think there is room for S&P to broaden out from the very concentrated leadership that we saw for most part of last year. But that can also be thanks to AI. So as we think about sectors like healthcare, sectors like industrials, starting to adopt AI to a greater scale, the leaders within those sectors are likely able to broaden the gap versus the rest of the peers within the sector, because they have economy of scale, they have a lot of data to play with. So we can see actually AI driving broadening out of the rally concentrated in tech so far. So that's one way that it can broaden out. Another way that it can broaden out can be a wild swing of rate repricing, right? So we're talking about 3 cuts now. And remember, at the peak hawkish moment of October, markets were still looking at 2 cuts. But we have really seen a wide range of rate repricing, which is also evidenced in the very high elevated rate volatility, the MOVE index. So there's no telling if we could see swing back of this rate repricing, and when that kind of tactical momentum plays out, that could benefit the broader market beyond the AI concentrated theme. But that's so short term because we have seen wild swing within short periods of time. That's not something that we're positioning our investment views around, but we acknowledge that this can swing within this short period of time.
So, Wei, I know you're overweight US equities, but also a sprinkle of Japanese stocks. Can we finish there? The Nikkei 225 is up by almost 20% year to date. It's been quite a run. Can you tell me how the Bank of Japan, in any way, shape or form, is relevant to that decision?
Well, it's the prerequisite on which the micro story can play out, which is our expectation and rationale behind our Japanese equity call. So we upgraded Japan twice last year, and we continue to like it at this juncture, even as it crossed the all-time high last made in 1989. So yesterday was a key event for us to watch. So if they are very kind of hawkish, viewing inflation as a problem, I would be somewhat concerned with our Japan call. But frankly, yes, they hiked rates for the first time in 17 years, but they hiked it in the most dovish way possible, right? So for example, they normally dropped yield curve control, but they're still saying in case of a rapid rise in long-term yields, they would make nimble responses, adjustments. So if that's not the definition of YCC, I don't know what is. So they really kind of very supportive and accommodative still, and that paves the way for micro positive developments to continue to be reflected in Japanese equity pricing.
Well, that trade is working out. Wei Li of BlackRock. Wei, thank you. We've been asking the question repeatedly, where does it leave the call on Japanese stocks if the yen starts to strengthen? I guess we should have been asking, where does it leave the call if the yen carries on weakening? Because we've had 7 days of Japanese yen weakness, getting closer and closer to 152. You know, we hear a lot of guests talk about being long Japan. I was going through the most crowded trades at Bank of America on the Fund Manager Survey when we caught up with Candice Browning yesterday. Long Magnificent 7, most crowded trade, to be expected, 58%. Short Chinese equities, 14%. Long Japan equities, 13%. Maybe not as crowded as I felt, at least, based on that.
Well, based on the fact that people come on and we challenge them to that whole idea, everybody's long Japanese equities, they say, yeah, it just reached a new record high, the first time since 1989. It's not as if we have a long way to go, potentially, with certain companies, Toyota including, that are actually delivering on their bottom line.
Things are changing. They have been changing there for a while now. The Nikkei 225 up by close to 20% year to date. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Israeli Prime Minister Benjamin Netanyahu is set to speak with Senate Republicans in a video call today. This coming just days after Democratic Senate leader Chuck Schumer called for elections to replace Netanyahu in remarks that drew criticism from Republicans, including Senator Mitch McConnell. Israel and U.S. Democrats are seeing a growing rift over Israel's need to enter the Gaza city of Rafah, with Netanyahu saying he sees no way to destroy Hamas without invading the city. Inflation in the UK falling more sharply than expected, cooling to the lowest level in 2.5 years. The Consumer Prices Index rose 3.4% in February from a year earlier. That's slower than the 4% pace the month before. Economists say the data keeps the Bank of England on track to reduce interest rates later this year. Carrying shares are plunging. The company warning sales at its key brand Gucci will drop about 20% in the first quarter due to a slowdown in the Asia Pacific region. The French company is struggling to keep up with rivals like LVMH and Hermes as luxury sales have cooled over the past year, especially in China. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, will the Federal Reserve open the door to higher bond yields?
They only showed 2 cuts for this year. We think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. If they show 3 cuts, the 2-year will probably rally by 5 basis points. Curve will bear steepen.
That conversation up next.
The Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Stocks just about turning positive in the last couple of minutes by not even 0.1%. We've been spoiled. All-time highs on the S&P 500 coming into a Federal Reserve that isn't going to cut interest rates today in the minds of pretty much everybody forecasting the Fed. Yields are lower by a single basis point, 427.87. Under surveillance this morning, opening the door to higher bond yields.
They only showed 2 cuts for this year, so they take out 1 cut. We think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. We think you'll see the dollar rally, and we think you'll probably see risk assets take it on the chin. If they show 3 cuts, as they had in December, and as our economists expect that they will, we think that the 2-year will probably rally by 5 basis points. Curve will bear steepen, and you'll sort of see dollar weaken and risk on.
Here's the latest this morning. Bond traders stepping up short bets against treasuries ahead of today's Fed decision, positioning themselves for a hawkish message from Chair Powell. Greg Peters of PGIM Fixed Income writing this: we're still in the strategic buy zone for bonds. True, credit spreads are much tighter on high-yield bonds, but yields on investment-grade indices are comparable to year-end 22 levels, and central banks are in all likelihood done raising interest rates. Greg, I'm pleased to say, is with us now. So, Greg, it begs the question, and if we can, let's go straight to the Treasury market. 430-ish on a 10-year in the last 24 hours, back through 470 in the last couple of days at the front end of the curve. Greg, is that a buy for you looking across the curve at the moment?
Yeah, look, I think we're in the zone. And so whether rates rally or not kind of misses the point, right? It's about the carry that you receive, the yield that you receive. And I think as a fixed income investor at these yield levels, it's a very attractive proposition. So, you know, our tagline for the year is yield is destiny. And I think, you know, you win by just having the yield, the income coming in the door. And if there is a blip in the economy, you finally have that protective measure of owning duration. So I think it's, I don't want to say a win-win, Jonathan, but it's a very attractive investment indeed.
Greg, how do you convince people that say, Greg, I get all of that, but I think yields are going up, inflation's coming in hotter, starting to see commodities break out, crude getting close to 90 again. I think I should wait. I think I can get an extra 20 to 50 basis points further down the road. What do you say to them?
Well, look, I mean, you know, timing the market is always quite challenging. But I think where we are from a starting point matters a lot. And so kind of the break even of, yield moving higher is quite attractive as well. So like you'll never time it, of course. But, at the end of the day, at 430 on a 10-year, I think that's a very attractive investment. And like I said, you have that protective characteristics of fixed income if and when the economy does roll over.
Greg, you have something for everyone. Yield is destiny. I want to make a T-shirt that says that. On the flip side, you talk about how fear but not fear itself, and talk about the possibility later this year of a taper tantrum with a negative ratings development for U.S. Treasuries. How does that kind of negative side of things feature into yield is destiny when you're talking to clients?
Yeah, look, I mean, that's a risk factor, Lisa, no doubt about it. I just want to be open and honest. I mean, I think we have a tremendous amount of supply hitting the system this year. There is such a focus on Fed policy. And I do believe the markets were leaning the other way, just really embracing rate cuts way too early. I think we're in a much more natural state today than where we were at the start of the year, but it's a risk, and just want to be, eyes wide open to those risks. And, it's so much funding of the deficit on the come. You have to be focused on that potential problem.
It's the reason why we focus on auctions so closely here at Surveillance. And the reason why I do care, I do want to go back to this idea, though, that for now, it looks like an attractive buy. At 4.3% on the 10-year, does the Fed matter to you? Does anything that the Fed says today going to shift that view one way or another just simply because the market's moving away from the Fed and the Fed's kind of following it?
Yeah, so I think there's way too much focus on the Fed. At the end of the day, it's about the data. The data matters. Once again, if you rewind the clock, the markets were so obsessed with, rate cuts. And the only way the risk markets could do better is if the Fed cut rates. Well, actually, no, it's about the data. The underlying data is strong. And so I would focus on labor markets 10 times over more than the Fed. So I think there's something to do today, focusing on Powell and the Fed. But at the end of the day, it's labor.
So less Fed, maybe a little more BOJ, Greg. Can we finish on the Bank of Japan? I think you'll allow us to do that. I want to talk about the BOJ. It is the last anchor around the neck of the global fixed income market being lifted. We've seen the ECB shift, seen the Fed shift. Now it's the BOJ's turn. Greg, when you think about not just the next 5 minutes, the next 6 to 12 months, the next 10 years, what are we going to look like compared to what we did look like over the previous decade or so?
Yeah, so you could see this situation where, Japan rises from the ashes finally, right? And so what we got yesterday, the BOJ is, moving policy out of negative territory, but that's it, right? So you'll continue to see, I think, a weak yen. I think you'll continue to see flows into Japan. There's all this talk around crowded trades, as you were mentioning earlier, around, equity markets in Japan. Most investors have shied away because it's been 2 decades of disappointment. So I think this is a very early stage move in Japanese markets. And I think what you'll continue to see is this much, much lower rate regime relative to anywhere else in the world. And I think that will fuel FDI and push that market higher.
Greg, can I ask you, Japanese investors had to look for income elsewhere. Certain European markets are vulnerable to this trend. I'm trying to work out how those flows are going to develop in the next few years. How are you anticipating that's going to happen?
Yeah, I mean, on the margin, you'll see that, and you've seen that pull back, but very much on the margin. I mean, just look at the interest rate differentials, right? So if you look at yields in Japan relative to anywhere else or most jurisdictions outside of Japan, there's a significant pickup. So I don't see a fundamental shift. There's a natural home bias for sure, but I think that's more on the risk side, equity side, than it is on the fixed income side. So on the margin, yes, but I don't think it's anything dramatic.
Hey, Greg, thoughtful stuff. Appreciate it, as always. Greg Peters there of PGIM Fixed Income. Bit of a clinic on fixed income today. We'll catch up with Steve Major of HSBC in the next hour as well, so look out to that. Jan Hatzius at Goldman Sachs coming on too to anticipate the Federal Reserve. We will be talking about the Fed with Jan. Bit of data as well. To Greg's point, though, this year, this is something that Dutta at Renmark talked about, others too. We talk about Neil way too much, I know. GDP, nominal GDP has been better than expected. Equities have been listening to that noise and trading on it and ignoring what's happening in the bond market. And the bond market would have been better off just watching the data and spending less time trying to guess the Fed.
The data, of course, is a bit confusing, and the Fed's obviously confused by it. The data that they're watching is interesting. Greg talking about labor markets, and we hear that again and again. Do you watch the quits rates? Do you watch the non-farm payrolls numbers? Which ones do you look at?
Up next on this program, Intel winning almost $20 billion in US awards for chip plants in a program designed to reinvigorate the domestic industry. That conversation up next. Intel up 3%. All-time highs on the S&P 500 going into the Federal Reserve decision later on this afternoon. Equities pushing higher in the green on the S&P, positive by 0.06%, up by 0.25% on the Nasdaq 100. Plenty of headlines in the bond market over the last few weeks. The 2-year, 10-year repricing higher. Yields getting back through 470 briefly, back through 430 briefly on a 10-year, 428.27 this morning, down a single basis point on a 10-year maturity. On the 2-year, 467.88. A wonderful time on a trading floor with Bank of America and the team just yesterday. Thank you so much for everyone that reached out. A lot of those interviews you can find online, including the one with Mark Cabana of Bank of America. And the point that Mark made, I think, is an interesting one, that maybe this move in equities just opens the door for yields to keep going higher because you're not getting the pushback at all.
When honestly, it's not just equities, it's also risk assets within the credit markets. I was looking at, for example, high yield bond spreads. They're now the tightest, the extra yield over benchmark rates. Now, the lowest going back to January of 2022. This is not a concern about credit risk, even with higher borrowing costs, which raises the questions, why can't that borrowing cost go a whole lot higher with an economy that still is chugging along?
Spreads are tight, stocks are at all-time highs. We'll find out if Chairman Powell in this news conference is bothered or not by financial conditions. Frances Donald of Manulife was with us about 40 minutes ago. She was saying the chairman needs to tell us what he's actually looking at, and we need to work out whether financial conditions are relevant or not, because earlier last year they were, and then later last year, all of a sudden, they weren't.
Is it or isn't it just finger in the wind? Because essentially a lot of people think it is finger in the wind, and it's basically pick your own data indicator that's going to paint a story that feels good at that moment. And so if there is some sort of shift, how do they communicate it at a time where in December financial conditions didn't matter? Maybe now they matter a little bit more.
Does yen weakness matter? Let's turn to foreign exchange. Just turn the page on this market. Dollar yen. Dollar yen right now. 7 days of yen weakness. We have not seen a streak like that since August of 2023. We are back to close to 152 at 151.71. Again, breaking out by another 0.6% or so off the back of a rate hike at the Bank of Japan. Win Thin of Brown Brothers Harriman made out that this isn't going to be a problem for the BOJ. They'll be comfortable with this. And let's wait and see. Let's see what headlines we get from Japanese officials. You know those stories, sources say that they're unhappy about what's happening, and then nothing happens. Let's see how many of those we get in the next couple of weeks.
Still, for Japan, though, what's interesting is their symmetry of risks is still they want more inflation. And so this is why I actually think that the Bank of Japan's hand will be called potentially a little bit more if Jerome Powell today has a hawkish message. If the Federal Reserve is concerned about inflation and wants to raise rates, that could potentially cause more capital flows into the U.S. away from Japan, leading to the end to weaken to a point where the Bank of Japan has to pay attention. And that might be the worst risk case for some of the officials that might be whispering potentially off the record to some people who are reporters.
Potentially, maybe at some point in the future again. It's a 3% move over 7 sessions. And those of you familiar with foreign exchange, you know a 3% move in foreign exchange. It's not the same as equities. That's a big move in FX over a week or so. Under surveillance this morning, counting down to the Fed decision at 2 p.m. Eastern Time. The central bank expected to keep rates on hold for a 5th straight meeting, with investors looking to Chair Powell's news conference for clues on the Fed's rate cut timeline. Earlier this month, Powell saying the Fed was, quote, not far from the level of confidence needed on inflation to begin cuts, but further hotter than expected inflation prints, reinforcing the case for caution here going into this. And this is what it's going to be about, that confidence line. How does he phrase the level of confidence that he has now relative to where he was at the start of the year?
2 things that I'm watching based on that kind of idea. Number one, how much do they revise upward their benchmark rate forecast for 2025 and 2026? I want to see that. And number 2, how much does he push back or even address the financial conditions question? If he doesn't address it, that will be so dovish, basically saying we don't care about how much the equity markets and credit markets have rallied. If he does address it, it indicates that maybe they're getting a little bit more nervous that the market is moving in the opposite direction from what they're trying to do.
2 p.m. Eastern, you'll get the statement and the summary of economic projections. 30 minutes later, you'll hear from the chairman himself. Some news on JP Morgan I want to bring you, lifting its quarterly dividend by 9.5% following record annual profit and regulators signalling they may rethink proposals for tighter capital requirements. It's the second time in the past year that the bank has boosted its quarterly payout. In the announcement, the CEO, Jamie Dimon, did not provide a reason for the increase. You will hear from him, though, April 12th. That's when earnings season starts to kick off. And can we just reflect on what we heard from Brian Moynihan? The customers, businesses are still pretty strong. But the point on M&A, I think we have to keep revisiting. The fact of the matter is that they are struggling to convince the banking universe, struggling to convince clients to enter into conversations about deals, because even if you agree to a price, agree to the terms, you could be left hanging out to dry for the next 12 months and Washington, D.C. throwing mud at you. Do you want to go through that if you're a large company?
What does a banking executive do with the behemoth that is Washington, D.C.? This, to me, is a key question. Do you just keep going down there and lobbying? Because you can't fight against that. And if deals might not be approved, well, how do you argue to your clients this is a good deal to transact in? Because, you may have some legal fees, but, it might be so good. This is not a good case for them to be making.
You can make a great case, and then you're just waiting for a tweet from Senator Warren and others to sort of pile on. And she's got company in the Republican Party now. This is the issue.
The key question for me is how much will there be some sort of surge in M&A post-election?
Yeah.
Or not? If Ed Mills is right, and basically the policies in either camp seem to be more or less similar to one another. Interesting question.
Let's stick with policy down in Washington and look at shares of Intel rising after the company won almost $20 billion in incentives to expand its semiconductor factories as the Commerce Department looks to reinvigorate America's domestic chip industry and reverse a production shift towards Asia. The investment in Intel is a key part of Commerce Secretary Gina Raimondo's plan to have the US produce a fifth of the world's advanced logic chips by the end of the decade. Bloomberg's Michael Shepard joins us now for more on this story. Shep, the money, we're finally starting to learn how big these numbers are going to be and who's going to receive them, Shep. How big is this going to be?
This particular award that we're seeing today is significant. It is the first to go out for advanced chip making. They've already doled out a few packages for older generation semiconductors, but this would go to the good stuff. This would go to what the U.S. is really trying to regain and maintain an edge on, and that is the most sophisticated chips that are out there. So the money will go to both production, but also to some research and development. It's concentrated in Arizona, and President Joe Biden is going to be out there later today to make the announcement in roughly the 1 or 2 p.m. hour our time.
Mike, I do have to ask about what Ed Mills was talking about, the idea that some of the defense spending in the United States is being shifted to technology investments because this is the new front for the Cold War internationally. How much is that happening? How much of the defense budget, and where is it going within the tech world?
Well, Lisa, this is a great question because our reporters who've been tracking the budget over the years have seen an increase in investment in technology, not only in the technology that just makes the Pentagon go from day to day, some of the back office systems, but really the technology that will power weapon systems and things like that, and power how troops are used and deployed and some of the thinking. We had a terrific piece maybe a week or two ago by Katrina Manson, who looked at the use of AI in warfare and how we're even seeing it deployed on the battlefield today in relation to the Houthis.
Mike, can we talk about the CHIPS Act? Can you tell me the terms that you have to follow to receive this money? What kind of terms are attached? Because clearly that's not free. What do they have to do to attract that kind of capital?
Well, that's a great question, Jonathan. Basically, what they are looking for is they want the companies have to show what they're going to do with it. They're quiet, though, in terms of what they're saying publicly, how the money will be deployed in each individual project, in each individual phase. And they're, for now, at least giving on a preliminary basis access to much larger pots and then working with the department on an individual basis, how it will be used at the facilities that they're developing. And remember, Intel is looking for this big footprint in Arizona. Part of it will be what will it look like in terms of creation of jobs and being able to sustain those jobs. The other part will be on the technology side. How good will the tech actually be, and what sort of a leap in generation will we get to see?
I think we can all agree we're late to this, Mike. This is something we should have been doing maybe a decade ago when China was talking about Made in China 2025. When are we going to see the results from this effort? How many years do we have to wait?
It may take some time. We are seeing the companies already starting to break ground and make moves. Arizona is one place where Intel is investing. Ohio is another. But it will take some time for them to actually bear fruit on these investments. It takes an enormous amount of capital and a lot of time to build one of these factories known as fabs and actually get it up and running. It requires a lot of people. And Taiwan in particular is one place where they have had this mission to build up their semiconductor manufacturing base. And Taiwan Semiconductor Manufacturing Company, as you know, is one of the world's leaders just because they have made this concerted and decades-long investment in this area.
Just to that point, Shep, how much is this trying to replace Taiwan as the center of chip production?
You know, this is a good question. When we speak to Taiwanese officials or around town and elsewhere, they do bristle at the idea that the U.S. might be trying to elbow them out. From the U.S. standpoint, it is a little bit less than that and a little bit more of bolstering what we've talked about before in this venue about economic security. They don't want to see all of our semiconductor capabilities and manufacturing housed offshore. They're concerned that if, heaven forbid, China makes good on some sort of plan to move on Taiwan militarily, what would happen to the U.S. access to chips? Never mind, all the other fallout from a military conflict. So there is that. And then there is also just the question of the U.S. has long been a pioneer and champion in this area, for decades with the military and space programs in the 60s and 70s. And so under President Biden, they have made, it's one of the pillars of his Bidenomics program, they have really been pushing this revitalization of the manufacturing base to try to bring some of that back here.
Shep, I just have to really wonder about the analog history rhyming. How much is this sort of a redux of Oppenheimer, Robert Oppenheimer, and sort of the whole Manhattan Project and putting tons of money into it to see what they could come out? Is this basically a similar, although technologically focused kind of transition where they're trying to funnel as much money into that to beat in the cyber race with some of the other big powers?
I think that there is an analogy to the idea of the initiative. I think one of the differences is that they're trying to be much more targeted and focused, and they're really trying to bring in, a range of people to the Commerce Department and other agencies to make sure that it gets overseen properly with, on the financial side and also on the technological side in very specific ways. One of the other differences I think we also see is that the money actually has a limit. There's $39 billion in grants and another $75 billion in loans and other guarantees for this program. And if you talk to the Intel CEO, Pat Gelsinger, who is spearheading this big effort to revitalize the company and move it forward, he says the U.S. will very likely need a CHIPS Act too. This investment that we're seeing from the government is really a drop in the bucket compared to what other countries have done with their manufacturing bases. Places like Taiwan and Japan and South Korea that have this tradition of, state industrial policy and investment.
I'm shocked that Mr. Gelsinger thinks there should be another act, Mike. Absolutely shocked. Michael Shepard, thank you, sir, down in Washington, D.C. I don't think Pat Gelsinger has ever sounded pessimistic about anything ever. Do you remember catching up with him a few months ago in Switzerland? I'm just waiting for his scarf to actually be a QR code. I really wanted that. That's what it looked like. I remember that, exactly. He was so optimistic, and I understand why if he's getting $20 billion of money infused. And of course, he's going to say we need more. And you can make the argument, but of course he's going to say that. This is my shocked face. If you are just joining us, the headlines crossed a little bit earlier this morning. Intel receiving $8.5 billion in grants, as much as $11 billion in loans to help fund the expansion of its semiconductor factories. Those federal funds expected to begin flowing by the end of 2024. That stock is higher by close to 4% in the pre-market through this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden and former President Donald Trump swept up more delegates in primary elections yesterday as they set their sights on a rematch in November. Trump won all 5 Republican primaries with 75 to 81% support, while Biden won 4 Democratic primaries after Florida canceled its vote. He received 83 to 91% of the vote. Kansas was the only state with a none of the above option on the Democratic ballot. It took 10%. The Texas migrant arrest law is back on hold. Just hours after the law briefly took effect, a federal appeals court stepped in, preventing Texas from arresting and deporting migrants accused of entering the U.S. illegally. A 3-judge panel intervened after a series of back and forth rulings that saw the Supreme Court weigh in. That 3-judge panel meets today. Michael Dell is unloading shares in his namesake computer company for the first time in nearly 3 years. Dell is cashing in as Dell stock soars on optimism over AI. For the past 2 weeks, the founder and CEO has been selling on a near daily basis, offloading more than 4 million shares worth about $465 million. He still owns about half of the Texas-based company. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, crude oil breaking out. That's next. This is Bloomberg. Equities on the S&P positive by close to 0.1% and counting you down to the opening bell about 90 minutes away, a couple of hours away. Equity futures doing okay. Yields are lower by, let's call it a basis point, 428.66 on a US 10-year. One eye on crude, just backing away a touch, but over the last week, under surveillance this morning, crude oil breaking out.
All the strength you've seen recently, and the consensus range is 70 to 90. Do you really want to be short $2.50 from here? Probably not. So I think we're going to see it bust well outside of that 70-90 range. I don't want to calculate how high we go. It's not my job anymore these days.
It's true.
But I think, the risk is clearly upside. I think the main point is I want to be long oil and the rest of the commodity complex in this environment.
It's fantastic to see Jeff Curry with a new seat, isn't it? Over at Carlisle. I think it's great. I missed him massively over the last couple of years.
We have to get him back in and talking about why so many people are bullish, because frankly, if you look at investors, they're not making the calls on exactly where the oil price is going to go, but they are mostly all bullish.
I'm going to ask him for a call. He's still got one, can't he? He's going to offer a price target, surely.
He's not going to offer it. He'll have one, but it's not his job to actually get pilloried for being wrong.
Triple digits, and this is why. With Jeff Curry, formerly of Goldman Sachs, and now I love Jeff. Jeff, if you're listening, I know you often are. It'll be good to catch up soon. Nadia Marder-Wiggum of Svelland Capital joins us now on her outlook for the crude market. Nadia, I think we need to get straight to this breakout we've seen, not this morning as we pull back, but over the last couple of weeks, even Brent getting close to 90 again. What's behind this breakout? We've been talking about why it hasn't happened for months. Then just like that, it starts to happen. What's behind it?
First of all, we haven't had inventories building in Q1, so all the market bears can't find those inventories that were supposed to come. Number two, and this is something he touches on, Jeff Curry, it's the whole complex breaking out in terms of commodities. The Goldman Sachs Commodities Index, everything is moving up. Copper, natural gas, and this is when we look at that $90 range. If we get, BCOM breaking out higher, then you get those passive investors buying oil right now that are a little bit short right now. They could be long oil, but short the index, right? So as this commodity index becomes more popular, you get that passive money in, which then propels the fundamentals to where we see them going, which is a much tighter market this summer.
You talked about copper close to 9K this morning on the London Metal Exchange. I think we broke through that level in the last week or so. Brent crude close to 90 in the last week as well. Are those stories different, or do they point to the same theme? Is that about supply and maybe not about demand?
It is especially about supply. But on the copper side, we've been waiting at Svelland Capital for this move for a long time. And the energy transition story is very important in terms of copper demand. It's been viewed quite negatively because of the housing situation in China. But we need to think about, infrastructure build out, not only completing a house at the last leg of that side of things, right? When we look at the oil side, demand continues to be strong. We expect to see growth in oil demand in China, but the main tightness is really in the refined product space. And this is where we expect refinery runs to be higher this year over year, because we need to restock on that side. And that requires more crude to run more refineries.
How much is some of the reporting out of Ukraine and Russia also affecting the price moves, given the fact that Ukraine is successfully targeting a number of different Russian sites, including refineries?
Yeah, in our view, this is a real game changer as the market starts to understand that we're entering potentially the next phase in the war. Ukraine is using Ukraine-designed drones to target specific refineries, hundreds of miles within Russia. That means they can take out refinery units as they wish. Already we have the impact right now in Russia of around 850 to 900,000 barrels per day of refinery outages. That includes refinery maintenance, right? Around 500 to 600 are because of what has been hit. when you take that out of the refinery complex globally, when Russia's already limiting exports of refined products, we have to look at where is the refining spare capacity in the world. And that is in China. And typically when this happens, we're talking about 1 to 2 million barrels per day of spare capacity. In Q2, China only has 300,000 barrels per day of spare capacity because of maintenance. So that means when everyone comes back from maintenance June, July, they're going to ramp really hard in terms of what they need to run. And this is where we think OPEC will have to change their strategy because all of that has to happen at once. Otherwise, we have no gasoline for the summer.
We've seen gasoline prices already ticking higher in the United States. Right now, it's at $3 and about 51 cents, which is the highest going back months. I'm looking right now, the highest since October 2023. How high could it go given the sort of blockade in the refinery process globally?
Well, I mean, we're traders, right? We look there. There's no peak number. It's until it's that demand destructive number. But it depends what the U.S. decides to do about this situation, right? In the worst case scenario that we have Russian refineries continue to get struck through Q2, the ones that have already been struck can't come back online. We then have a situation where Russia is importing gasoline or trying to import gasoline. What can NATO do? They can just blockade that, right? And so that is where we can have a limit on that gasoline price increase because then Russia is not trying to take in product that's available for the rest of the world. Even if NATO were to do that, though, we still see upside to gasoline prices from where we are now, especially because the U.S. economy is looking quite all right.
Can we wrap things up by what you said about OPEC? You said OPEC will have to do something. What did you mean by that?
We believe it's not only they can bring back barrels in Q3, they will be compelled to bring back barrels in Q3 to prevent the market from hitting a demand destructive number in terms of refined products. We expect already in June for refineries to ramp up, and that will probably promote a little bit of cheating within the group. So come the meeting, they'll decide, with the market as it looks now, that they need to bring back at least 500,000 barrels per day of production, maybe up to 1 million.
You said Q3. There's an interesting thing happening in Q4. It's the US election in November. You remember the midterms. We talked about the SPR as if it was the strategic midterm reserve. Do you remember that conversation?
Oh, yeah.
Not my phrase.
I know.
It was someone else's. But Nadia, there was big pressure on the Saudis then to increase output because it was believed that the president wanted lower oil prices going into the midterm elections. Now, I just wonder if it's in Saudi's interest, in their own interest politically, to do what you're suggesting they will need to do in Q3. How will the politics play into that decision?
Absolutely. The Biden administration will push this and the Chinese will need it as well. So it's both sides of their consumer pool. So it just makes sense.
Honestly, to me, this is just fascinating. I just wonder how much this is essentially going to cap the prices. Is this basically a cap to how high prices could go?
Well, it's a solution that doesn't solve the entire problem because the tightness is in that refinery sector, right? But it will help ease things. So we can actually get through the summer.
Nadia, appreciate your perspective on this. Nadia Martin-Wigan there, Asfelin Capital. And why we're seeing a breakout in commodities, not just crude, but copper too, what's behind it, supply side story, and perhaps why OPEC will need to act in Q3. But the politics of acting in Q3 going into Q4, I think it's less obvious. It's hard to read the tea leaves on this one going into the end of the year.
You think that OPEC Plus is going to want to stick it to the United States?
Well, when we say OPEC Plus, who do we mean? We're talking about Riyadh. We're talking about Saudi Arabia. All I can do is lean on the experience of what we saw going into the midterms. And there was some real tension then between this administration and the Saudi Arabia Kingdom and Riyadh. And I just wonder if that tension is going to be there in quite the same way in a few quarters' time.
Especially if they support one candidate more than the other and they want to sort of put their thumb on the scale, because this is one of the cleanest ways to do so, considering that when oil prices tend to be higher and gas prices are higher, people tend to feel worse, and that affects elections.
It's going to be part of the calculation, conversation, let's put it that way. To Nadia's point, though, China needs it too. And I think maybe that's the thing that tips the scales if it needs to happen. But let's see where we are. I mean, look, crude is a difficult thing to forecast. And as I often say, if you want to make a fool of someone, ask them for where they think crude's going to be in 3 months' time. And they'll probably look a fool.
The U.S. is the swing factor in terms of production, seems to be shifting, and the story is shifting beyond that, and that, I think, is something significant.
The third hour of Bloomberg Surveillance up next. We'll catch up with Steve Major of HSBC, Jan Hatzius of Goldman Sachs, David Lefkowitz of UBS. A fantastic lineup going into the Federal Reserve decision later this afternoon.
The Fed has latitude that a lot of places don't have, that they can be hold restrictive and let the economy really catch up.
If financial conditions are easier, then there's less easing for the Fed to do.
They're telling you we want to cut rates. The problem is the data is not letting.
There's no doubt that financial conditions have eased rather dramatically in the course of the past few months.
I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, it is Fed decision day, and going into that decision this afternoon, equities all-time highs, adding some weight to it this morning. Credit spreads very, very tight, and trying to work out what on earth Chairman Powell is going to say in this news conference at 2:30 p.m.
Honestly, what people are looking for is some pushback to market activity, as well as maybe some walking back of this desire to cut rates, because right now in the market there is this belief that the Federal Reserve wants to cut rates regardless of data that's not really cooperating.
He only spoke a couple of weeks ago at the semi-annual testimony down on Capitol Hill in front of the House and then the Senate, and basically said we only need a little bit more confidence. So what's changed? Has the hot CPI, hot PPI story changed that?
Yeah, there hasn't been that confidence. There hasn't even been a little bit more confidence. And some people are now saying that if you look at the year-over-year comps, it's going to get really complicated to really get down to the levels that they want to see by summer. That said, how much are they concerned about the asymmetric risk of a downturn happening very quickly and all at once? And that, to me, is going to be a key question. Do they still see that as a bigger risk than runaway inflation?
He framed his reaction function in January pretty clearly. He basically said that strong growth isn't a problem and we can respond to weak growth. I wonder if that story's changed in any way, shape or form. Also have to discuss how relevant this is to equity markets, given how many cuts we've priced out so far in 2024. And the fact we're sitting here in March, which was meant to be the meeting they were cutting interest rates at, by the way, only 3 months ago. And here we are with stocks at all-time highs, and that's not the conversation at all. We're not talking about cuts at this meeting, and stocks are doing okay.
If your head is spinning, join the club. And I do wonder at a certain point if, yes, stocks can keep rallying because of the names that are not vulnerable to interest rates. Big tech. They have huge cash flows, and they don't necessarily have that much debt. Do you see the bifurcation continue, the broadening out that everyone's been looking for, get delayed and delayed and delayed and delayed, just simply because those tend to be, those other 492, 93 names, tend to be the ones that are more leveraged to some of these rates? This is sort of the dynamic that everyone wants to die and just isn't going away.
We should stop talking so much because we've got a fantastic lineup this hour, which I'll get to in just a moment. Equities doing okay, positive by 0.1% on the S&P. Coming up this hour, we'll catch up with HSBC Stephen Major on his bullish Treasury call, Jan Hatzius of Goldman Sachs on why he thinks inflation will fall in time for a June rate cut, and David Lefkowitz of UBS saying the equity rally has room to run. We begin with our top story. All eyes on the Federal Reserve decision coming at 2 p.m. Eastern time. Bond yields rising this year as data comes in hotter than expected and the timing of rate cuts is pushed back. Stephen Major of HSBC staying bullish, saying this: in anticipation of rate cuts, we take bullish duration exposure in Europe and stay at mildly bullish for treasuries. Steve Major is with us around the table. Steve, good morning to you.
Morning, John.
Can we start with that mildly bullish story for treasuries? Yeah. Why mildly bullish in the face of a bit of a sell-off we've seen so far this year?
Well, mildly bullish is not all in. All in is full-on bullish, and that's why Europe is ranked above the US in terms of possible easing and performance from duration. But we can't let go of this view that yields are going to be lower, not higher, by year end. And I get they've been sliding up the last week or so, and I mean, the context is important. We've come a long way from the peak in yields in October. The inflation peaked in June 2022. The market changed its directional view on rates in October 23. The Fed pivoted a couple of months later. It seems to me that they're not going to change their mind. The next move is down. And in the meantime, we know it's either unchanged or down for policy rates, and therefore the trade is sit in the belly of the curve. If not treasuries, you take IG credit. And if you can't take those, then what's it called? T-bills and chill. Is that what they say over
That's
here?
what they're saying stateside, yeah. T-bills and chill.
I've been here long enough now to
Picking
get
up the lingo?
Yeah.
Let's go further out along the curve, get away from the belly and go out to the 10-year say.
Yeah.
What backs up this call at the moment that yields at the end of the year will be lower, not higher?
So if you took the most hawkish individual in the December dot plot, you get a longer run equilibrium rate just below 4. And you get very little rate cuts in the next year or so. So if you just took that as a path for rates, it's difficult to get the 10-year yield much above 4.5 on our calculation. And you'd be really going some to get to 5. So just knowing that right-hand tail of the distribution is sort of in at 4.5 and change, I quite like the idea of being long. Now, it's very difficult to time this, and that's why the best trade, which I think everyone seems to be doing, is owning the corporates, taking all the new issues they can, and complementing a position in IG credit with T-bills. And that generates a total yield of between 5 and 6 that competes with equities. And on a risk-adjusted basis, it's superb. So I think that's what's going on. If you're in T-bills and they're maturing, you've got the option to roll them again or go and buy something else. Now, the thing is with buying the 10-year Treasury, you drop 100 basis points in yield. But at least if you go to IG credit, you can sit and wait. And I think that explains the tight credit spreads. I don't think we can infer too much reason in the credit spread as to say something about default probability. I think it's the all-in yield that people like. They can't get enough.
I was very excited to speak with you today because for so many years, I remember all of the people who are calling for some huge sell-off in treasuries, and I'd get the major letter, and it would come out and say, you're all wrong, yields are going lower, because basically we're looking at a low inflation, low growth reality. That was before the pandemic. A little bit after the pandemic, it sounds like your thinking has shifted somewhat, given the fact that you're not aggressively bullish in treasuries. Has it? Has the neutral rate shifted? Has something about your view of the world changed?
The quote that John lifted is for our March asset allocation, so it's the monthly, right? The view hasn't changed. Our year-end forecast is 3.0. That seems a long way from here, but believe me, once they start cutting, the market's going to move quickly, and this is the issue that people have. Is that it's very dangerous to be short of treasuries here. You've got to have a very interesting narrative to justify being short of treasuries. So the minimum you can be is neutral and small long. I think that the growth narrative has been the biggest challenge. And if I put together what explains US exceptionalism, it's the fiscal population growth, maybe even some productivity, who knows. But the thing is, that explains what's happened in the last year or so. It doesn't tell you the next 10. The 10-year Treasury yield should reflect the average over that period. Does anyone really think that 3% real GDP is going to be the case for the next 10 years? Because it looks to me that that's very unlikely.
But maybe not. Maybe the growth story isn't going to be there. But there is an argument for the inflation story to be there, especially given the election, especially given more protectionist policies, especially given some of the issues that are not going away with respect to wages and just the fiscal money that has been, pro-cyclical, which is sort of counterintuitive. How do you dismiss all of that?
I don't want to dismiss it, Lisa, and you're right. The last bit on inflation has been sticky, but the big picture, where we've come from since June 2022, it looks like a symmetrical reversal. So it went up and it came down. We're not quite on the target rate yet, but they don't have to arrive at the target before they cut rates. That they would be almost irresponsible to wait until after they've hit the target. I can't dismiss what you're saying. I don't dismiss it, because to me it's about probabilities and scenarios. So the sort of no landing scenario whereby inflation stays sticky and high, growth ticks along, that says there's no rate cuts this year, in which case 2-year yield should be 5.25, 5.5. I get it, 10 should be 4.5, 4.75. That's sort of where they would land with no landing. But soft landing is where we are today. And we've got this risk on the left-hand side of the distribution here of a hard landing. Has it really gone away? This time last year, people were cancelling meetings with me. There's an easy thing to do anyway. But,
Banks were fake.
No, because it was the regional bank stress. Right? People say to me, what does a hard landing look like? Well, the first thing is this interview doesn't happen. Right? So it's, people have forgotten a year ago, for a good few weeks, we had the smell and the look of a hard landing. 2-year yields were screaming down towards 3%. Right, so I'm not saying that I know anything that's going to bring that back, but it's just about probabilities. It seems to me that we're leaning a bit towards no landing, soft landing, stagflation. That's what it's all leaning towards. And to me, bonds protect you in case that's wrong and you go back the other way. So that's the explanation, Lisa. I can't let go of the fact that I think rates are going to be coming down. And when they come down, the market will price more. And that's how the bond yields get down to a lower level.
So that was Q1 last year going into Q2. And then Q3, we printed something like 5% on GDP stateside, which is kind of wild. And then we were seeing the highs of the year on a 10-year and on the 2-year in October of last year, as you mentioned. And I don't remember something you said about supply and some reflections you had at the time about whether supply matters or not. And now the answer is, it depends. Can we talk about what it depends on? Yeah. And the fact of the matter, to Lisa's point, that we've got this sort of pro-cyclical fiscal policy in the US now where deficits are massive with unemployment south of 4%. Does that matter to the ultimate call?
I was here this time last year and we discussed it, and yields were pushing towards 5 for the 10s, and it was on the supply-demand imbalance. Looking back with hindsight, maybe the Treasury made a misstep with the amount of coupons they issued at that time, given the GDP, the downgrade, the inverted curve. I mean, it's easy for me to sit here and say so afterwards, but it looked like that was a misstep. And it was addressed in the November refunding. Now, I think that on the whole, supply should not matter to your yield forecast. It can matter to your near-term tactical view if there's an auction coming up or there's some kind of thing. But, you know, the supply impacts term premium when there's a surprise and there's an imbalance. In the longer run, I think the stock of debt, the huge stock, and let's remember it's virtually doubled in the last 2 administrations, under both of the last 2 presidents. We're at close to $27 trillion of marketable securities. That's double early 2016. So that weighs on future growth, and that pulls the R-star down. Everything else being equal. The way that happens is through debt servicing. So the way that bond supply deficits feed into the way the bond market behaves is 2 different things. There's the imbalance which can hit the term premium, lift it up, short term, and there's the longer term, what it does to the equilibrium policy rate. And I think there's unambiguous evidence that the stock of debt weighs down. So it opposes the positivity of the population growth and the near-term impulses that might come from AI, etc. But the debt stock weighs the other way.
Yesterday, just to put a bow on all of this, Mark Urbana of Bank of America was saying that maybe bonds should take a message from stocks that keep flying and that it shouldn't be stocks taking a message from bonds. Do you push back? Do you saying that actually stocks seem to be listening to a risk that's getting baked into bonds, which is why yields are not even higher?
That's a great debate. I mean, it's an interesting insight. Why not? We're always looking at new ways of valuing bonds, but it seems to me that the yield on the 2-year Treasury, you can see quite robustly and justify it based on the path of the short rate. And so if it's 470-ish, it's reflecting a Fed that cuts a couple or 3 times this year, continues next year. That's basically what it's priced. Now, that's an important number because it affects the 5s and it affects the 10s. Now, I think equities seem to be taking the positivity from what the bonds are telling them, so that rates are coming down. I think bonds are purely priced off of the short rate and its path, so I don't think that they're priced due to equities at all. But it's an interesting debate. I mean, I'd like to see how we could use equity risk premium to influence our valuation on bonds. I don't think we can. It strikes me that it goes the other way. Unambiguously, it's bonds to equities, I think.
Steve, this is awesome. We'll continue this conversation. Steve Major of HSBC is going to be sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here is Yahara Hackers. Hey, Yahara.
Hi, John. Boeing is warning regulator scrutiny and a slower output of the 737 MAX will mean less cash. The company's CFO telling a Bank of America conference that margins will run negative 20% in the first quarter as it pays out compensation from January's Alaska Airlines blowout. Boeing says it will still have enough cash on hand for a potential purchase of Spirit Aerosystems. The plane maker says the buyout is best for quality and safety as the FAA ramps up pressure on Boeing to improve its culture and practices. Samsung shares posting their biggest gain in more than 6 months after a backing by NVIDIA. CEO Jensen Huang reportedly said he plans to use Samsung as a supplier of high-bandwidth memory chips. NVIDIA unveiled its next generation of AI hardware called Blackwell at its highly anticipated conference in California earlier this week. Intel is in line to receive nearly $20 billion in grants and loans from the U.S. to build semiconductor plants. This marks the largest award yet in an effort by the White House to bring chips manufacturing back to the U.S. The award comes amid an ambitious turnaround plan by Intel CEO Pat Gelsinger. The stock is up in pre-market trading. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, a shaky Japanese yen.
Because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle, that in reality, this is not that consequential of a move.
Dollar yen higher for 7 consecutive sessions. That is a weaker Japanese yen. That conversation up next.
The Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City, 1 hour and 12 minutes away from the opening bell. Equity futures on the S&P 500 shaping up as follows. We are just about negative by 0.03%, going nowhere after going somewhere this year, and that somewhere is higher to all-time highs going into the Fed decision later on this afternoon. Under surveillance this morning, a shaky Japanese yen.
Because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle, that in reality, this is not that consequential of a move. BOJ almost like needs the Fed to ease now or ease soon because they'll do a lot of the work for them. But if not, then you have a risk that this 150 numbers is a big deal on the dollar yen.
Here's the latest this morning. The yen is at risk of sliding back to 3-decade lows against the dollar after the BOJ ended negative interest rates without clear guidance on further hikes. Steve Majors with us of HSBC, with us here in New York. Steve, got to talk about this. First move from the BOJ, first hike since 2007, and proving not to be so consequential. The yen moving in the other direction. How are you reading developments in Japan?
Maybe it is consequential because maybe it opens the door up for the next step, the next move. Because if you were scenario playing, role playing before this event, you would have said, imagine a scenario where they went all in, when they did rate hikes and the yield curve control and this, that, and the other, really hawkish, and dollar yen went up. And actually, that seems to be what's happened. So, to me, the totality of the decision and the outcome in the asset markets is the measure of success. So you have to look at all the different details in what they did, and then how all the asset markets play out. And they're watching this closely. I would say that net, it looks like there's room maybe to do some more of something. Now, from a JGB perspective, maybe it means yields can keep going a bit higher. Dollar yen is that's probably not what they want to see.
Well, that's what we're getting to. Sort of to define success, I need to understand what the objective was.
Yeah.
Surely the objective wasn't to see a weaker Japanese yen off the back of this.
The key performance indicators for this one would be not to break anything or make any mess. It's a bit like any big decision from any central bank. First stop is don't make a mess of anything. So in that regard, it's okay. But it just seems to me that it's not really over. There's much more that could be done. The fair value for JGBs with this rate move and the changes on the yield curve control could be nearer to 100. And it's interesting that it's the currency that moves, and that tells you that maybe investors are putting their views through the FX markets more than they are through the bonds at the moment.
So a lot of people are saying that the Bank of Japan is not going to be bothered necessarily by this move in the yen. Do you disagree?
I think they'll be delighted just to have got rid of negative rates. So in that sense, I totally agree. They're not bothered about it at all because if their objective was to get the rate up without making a mess of anything, then they've achieved it. But I think it's the totality of the asset class response that matters, and that takes time to look through. It's taken them how many years? 17 years to get here, and it's step by step. So I think it's conditional, Lisa. I think that their analysis will it'll be ongoing, and they'll be looking at what's happened to dollar yen and to the equity market and to bonds, and that will help frame what they do next.
What was interesting to me was a lot of people were saying that maybe if the Bank of Japan ended negative rate policies and actually tightened more significantly, all of the Japanese investors who had been pouring their cash into U.S. credit markets, into European markets, would come home, and that buyer base would not be there in the same level. Do you see that as a potential likelihood, or is what we're seeing what we're getting, which is essentially the dynamic is kind of the same?
I think that the Japanese investors are still very happy to hold dollars, and there's such a big yield gap between the two. That's the thing. For there to be a change in the direction of the yen, clearly more has to happen. If you told me today that policy was being shifted in a way that dollar yen would head back towards 140, then that changes everything. It changes all the hedging strategies, but obviously they haven't done enough to change the direction. So I'm not saying this for sure, but it strikes me that the outcome of this could be that there might be more moves and more iterative steps, especially on the JGB side.
Which raises this question about the threshold for today's Fed meeting and how hawkish Fed Chair Jay Powell would have to be before you see a move in the yen that would actually cause the Bank of Japan to say, wait a second, maybe we need a second step.
Yeah. I think that's unlikely, but given what we've just seen, why not, though, Lisa? Given if we'd sat here, if we'd sat here last week and called higher dollar yen on the basis of what we've just seen, it would have been an outlier. So why not? Let's go with it, right? So Chair Powell goes hawkish again and says it was a mistake. What I said before. He's not going to say that, right? The one thing you can say for sure, you know that. What else he's not going to say.
Chairman Powell's capable of going off script sometimes.
He's not going to say.
Not like that.
We can guarantee that's not going to be said, right?
Yeah.
Steve, just a final one. Steve, can we reflect on the previous decade or so in this fixed income market? I was in Europe. We were there together. We used to talk about negative bond yields. And Lisa, what did we get up to? 20 trillion? Some ridiculous number of negative yielding assets. What was that period? How would you describe that period? And for those that maybe have just joined the industry and weren't living it, how would you describe that period to them?
Well, it was an experiment in monetary policy. And it was obviously a scary time because the policies were there to address the risk of deflation. The counterfactuals, we don't know what would have happened without some of these policies. I think they get a bad rap, negative rates. I'm not saying I'm a fan or anything, but it's just that they get a bad rap. And what else were central banks supposed to do? Honestly. So I look back at it and I think it was an experiment, and it might have had some quite serious unintended consequences because, well, it shouldn't have been a surprise that asset prices went up so much on the back of this.
How would you judge the success, though, of them?
Well, as I say, it's the counterfactuals. So how many people would have lost their jobs without this? And there's been analysis on this from the Bundesbank and from parts of the ECB. I mean, this is the thing. Did negative rates actually keep the unemployment rate lower than it would have been otherwise? And that's a really important thing. You can't measure just how important that is for society. So if we just look at negative rates and say, oh, look what they did, they created all of this asset price bubble and all this, that's not, the full analysis is going to look at the real economy and especially employment.
And how much worse it could have been. Steve?
Yeah, exactly.
Fantastic to see you. It's good to catch up. Steve
Likewise,
Major of HSBC. Just remind me that price target. 3% 10-year yield? That's the yield target year end on a 10-year? Okay.
He looks slightly in pain when he talks
You're going to join us before year end?
I'll be happy if you'll have me.
Of course. Always. Coming up very shortly, we'll catch up with Jan Hatzius of Goldman Sachs, looking ahead to that Fed decision a little bit later on this afternoon. And we'll see if Chairman Powell enters the news conference, sits there and says, Bramo, I got it wrong.
Yeah, that's not going to happen. But stay tuned because maybe he will. Maybe I'll come out and say, sorry, guys. Whoops.
The risk factor in the minds of many is whether that median drops from 3 cuts to 2. We'll see in the projections that we get at about 2 p.m. Eastern Time. Mike McKee's going to break that decision down. We'll get a preview from Mike in just a moment. Then we'll catch up with Jan following that. From New York City, this is Bloomberg. 60 minutes out from the opening bell. Equities yesterday closing at record highs this morning, just about unchanged. Treading water going into Chairman Powell later on today. The Nasdaq positive by 0.2%. In the bond market, no major moves here to talk about. Over the last week, we've had quite a move, getting back to about 430 on a 10-year, close to 470 on a 2-year maturity. So we're very close, very, very close to the highs of 2024. Plenty of entertainment in foreign exchange. Of course, maybe not so entertaining if you're on the wrong side of what's happening in the Japanese yen at the moment. Dollar yen 151.68. 7 days of weakness, Bramo. It's kind of amazing to see every time we look at it.
Well, you've got stock markets in Japan at the highs going back to 1989, and you potentially have the yen at the weakest levels, potentially going back to 1990 when you talk about versus the dollar, and going back 16 years versus the euro. So what's going to give first, right? And this is sort of a key question. What does the Bank of Japan care about more? Juicing growth at the expense of their currency, or really trying to bring that under control more significantly?
We've had a move one way from the BOJ. Will we get a move another way from the Federal Reserve? Under surveillance this morning, the Fed decision, 2 p.m. Eastern time. The FOMC widely expected to hold rates steady, but investors are looking for updates on the dot plot and summary of economic projections. Bloomberg Economics still expecting just 3 cuts this year, despite a string of hot inflation prints since the January meeting. Fed Chair Jay Powell set to speak at 2 p.m. Eastern time. And in that meeting, at 2:30 Eastern time, Mike McKee, you'll be there, Mike. What's the focus of this news conference going to be for you and others?
I think most people are going to be looking to the idea of when do they cut, and obviously if there's a change in the dot plot, does that signify something significant? There is talk that maybe the strong jobs numbers and CPI numbers will cause them to cut back from 3 rate cuts this year to 2 rate cuts this year. So that'll be the first thing that everybody looks at. Then we'll look at the summary of economic projections and see if they've changed their inflation views. And so it's kind of the same question that we usually run into with them is, when are you going to do whatever it is that we think you're going to do? You can see there that right now what we're looking at is a tie between sort of June and July for the first cut. Markets are still expecting going into this meeting that there will be 3, another one in September, another one in December. So we may have a big surprise or we may not.
And Mike, he's been offering us some guidance. He's been saying we just need a little bit more confidence. We need more confidence. Mike, I'm wondering whether he's lost any in the last month. Do you think there's reason to lose confidence?
I don't think there's reason to lose confidence. I think what's happened is we've created more uncertainty. Not we, but the data have created more uncertainty because the economy is stronger than people think. The Fed has always thought that inflation would be bumpy. It would be hard to get from 3 to 2%. Do we think that this is harder than they anticipated? That's a question for Jay Powell. But markets are trying to put the strong economy together with where the Fed is and see if they line up. For the moment, it looks like they do. But, of course, we have to wait and see what the chair says.
Do you think that he'll come out and say, I'm sorry, I was wrong, and maybe financial conditions are loosening a little bit too much?
Anything is possible, but generally one doesn't hear that from Fed officials. But the question is, are financial conditions loosening enough or too much at this point? Because the economy is stronger than people anticipate. So there's a logical question of whether the Fed funds rate is tight enough at this point, and whether they think they need to do more if the economy stays this strong, or whether it's just a question of keeping it where it is for longer. I think that's the answer, but that's a question for Powell. The one other thing we might look for here is whether they change the long-run Fed funds dot, the neutral rate. Has that moved up? Do they think that it is now higher than it was? It's been 2.5% since John was a little boy. I don't know that they're going to change it, but that would be something for people to look at.
Mike McKee, thank you, sir. Appreciate the update, as always. Jan Hatzius and the team over at Goldman Sachs falling in line with the broad consensus, expecting 3 Fed rate cuts this year. Hatzius writing this: inflation has been firmer in recent months, but we think it is still on track to fall enough by the June meeting for a first cut. This has become less obvious, though, and our inflation path for the rest of the year is now at a range where small surprises could have large consequences. Jan, I'm pleased to say, is with us in the studio in New York. Jan, good morning to you.
Great to be here.
Fantastic to catch up with you, sir. I remember the outlook to start this year, and we talked about it a lot on this programme. The hard part was over. It's almost easy from here. Do you still think that's the case based on the data we've had so far this year?
Yeah, it's more of a question because of the stronger inflation numbers. But I think if you look at the trends, we're still on track to get down to the 2.4% range or so for core PCE inflation by the fourth quarter. Now, at the start of the year, we thought that was going to be 2.2%. So that's been, a little bit higher. We've basically gone back to the forecast that we had last fall. But 2.4% is still, pretty good progress. And by 2025, I think we'll be at 2. If you look at the drivers of inflation, whether it's on the goods side or on the rent side or in the labor market, I think the trends there still look encouraging. But of course, the prints have been higher. So there's more of a debate about it. And the Fed is going to be responsive to kind of near-term surprises.
Well, let's talk about how responsive they might be today. As we know, clear and obvious risk factor is in the dot plot, whether that median dot shifts from 3 cuts, say, to 2. And as we all know, it only takes 2 officials to move in that direction. Do you think that's something that happens today? Is that a base case in today's meeting?
It's not a base case for me, but it certainly is a possibility because not that much has to change in terms of the projections. If you go back to 2 weeks ago when Chair Powell testified in Congress, he said they were, pretty close to having enough confidence. So that sounded like, a cut no later than June. If you take the statements there, we've had higher inflation numbers in the past week. So the question is, has that changed his view? My expectation is no, but we'll find out at 2 p.m.
All things being equal, it seems to have changed your view on the margins. You shifted down to 3 rate cuts expected for this year from 4 earlier in a report in the past couple of weeks. And you said this line that John noted, small surprises could have large consequences. What do you mean?
Well, if you have a few additional tenths of inflation by the end of the year, even if it doesn't really change the overall trend, 2024 is still lower than 2023, but they would deliver less cuts. So in that sense, I think it'd be a continuation of what we've seen in the last several months, where in the early part of the year, with an expectation of inflation coming down to very close to 2, I think they would have done more. But now it seems like the December dot plot and the December inflation forecast looks pretty reasonable to us.
It seems like people are split on their views based on whether they think that the neutral rate has shifted materially or not. You believe that the neutral rate is still going to be around your previous projections of 3.25% to 3.5%. How do you push back against people who say it's actually 4% or higher, like El Salinos of RBC Capital?
I think we don't know, and I wouldn't push back very hard because the confidence interval around any of these estimates is quite high. 4%, though, is still well south of 5 3/8. And I am pretty confident that at current levels, we're in restrictive territory by a significant amount. But whether the right number, is 4 or 3.5 or 3, that's harder to know. I do think that the FOMC projection, 2.5%, if you take the median, that looks pretty stale. And I think that is going to drift up over time, probably by a little bit today, although we've been waiting for this for a while, and so far it hasn't happened, at least as far as the median is concerned.
You're a precise man and very careful with your words. When you say we're in restrictive and significantly so, what guides that? Where does that come from?
I think all models of neutral rates, and they're all pretty imprecise. This is not precise. There are many different models. Each of them has a significant amount of error, but you're going to be hard pressed finding a model that says 3% plus on the real rate, on the real funds rate is neutral. So it's really guided by a variety of different models. Some developed at the Fed, some developed elsewhere that say right now we're outside that range of uncertainty.
Can I ask you this question then? If I was a first-year intern at Goldman Sachs, I'd create a model really quickly and I'd say, Jan, unemployment's south of 4%, equities are at all-time highs and credit spreads are super tight. Why is that a bad model to sit here and say that maybe we're not that restrictive at all?
Well, so there's kind of short run and long run. So I don't think that the current level is very problematic in terms of near-term growth. And as you know, our forecast on growth is well above the consensus and continues to be. But over time, once the kind of short-term moves in financial conditions, short-term moves in fiscal policy and other forces play themselves out, I think it's pretty clear that the current level is above normal kind of neutral levels. And so over the medium term, it's very likely that we will see declines in rates, but the time path is going to be guided by the data.
So you don't think it'll be important for Jay Powell to push back against some of the record highs on stocks and some of the tightening in credit spreads?
Well, he would never comment on near-term market moves, of course.
Right.
So you say that, but actually I remember that meeting where that journalist, and it was an honest mistake, said to Powell that markets were rallying. And I remember his response to it in the news conference, and we all talked, I think it was Jim Bianco of Bianco Research that called it Powell's hawkish hits. He just came out, and the hawkish tone that he used once he thought that markets were going against what the Federal Reserve was trying to guide them to, I think it was pretty stark, strong, maybe even profound. Why isn't that an option he could take today? In the face of CPI that's coming in pretty hot, we've taken out cuts and this market's off to the races. Why wouldn't that be something that he'd be concerned by?
I don't think it's a problem because I don't think he's trying to slow things down significantly. I mean, the unemployment rate has drifted up somewhat. We're still seeing rebalancing in job openings. The quits rate is coming down. Inflation is going down. The sequential numbers have been a little higher, but the year-on-year rate has continued to come down. I don't think he's going to be particularly worried about having to squeeze the economy. He can respond to surprises by delivering cuts a little bit later, delivering cuts a little bit earlier, but I don't think we're in a very different situation from where we were a year ago, or
this
certainly
is the
2
change
years
you've
ago.
identified too, and it's implicit in your forecast. And you're right to point out that your growth forecasts have been above the street ever since you came out with your outlook. Strong growth doesn't appear to be a problem to the Federal Reserve. Why is that? What is different about this moment?
Well, because I think inflation is much lower, and it's heading down, and the year-on-year rate is still heading down. The labor market is much closer to balance, so the inflation expectations have continued to come down. They've now largely normalized. So all the things that Fed officials were very worried about a year and a half ago, that you'd get anchoring of inflation expectations, you'd get a wage price spiral, I think a lot of those things have moved into the rearview mirror. And so therefore, they are much less concerned about easier financial conditions. They'll still be relevant for setting policy, but they're going to be much less of a concern than maybe in this episode that you mentioned.
Jan, this was great. It's always fantastic to catch up, sir. It's been too long. It's good to see you.
Thank you.
Jan Hatzius there of Goldman Sachs, breaking down his outlook for the Federal Reserve and this economy beyond just the next 5 minutes and the next few hours, going into this Fed decision a little bit later on. That Fed decision, 2 p.m. Eastern time. We'll get the statement, the summary of economic projections. 30 minutes after that, 2:30 Eastern, we'll get the news conference with Chairman Powell. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Irish Prime Minister Leo Varadkar has announced he will step down. Varadkar says personal and professional reasons are behind his decision. He will stay in the position until his successor has been chosen. Ireland's next general election is planned for March 2025. JP Morgan lifting its quarterly dividend by 9.5% following record annual profit, and regulators signaling they may rethink proposals for tighter capital requirements. It's the second time in the past year that the bank has boosted its quarterly payout. In the announcement, CEO Jamie Dimon did not provide a reason for the increase. Ukraine's prime minister says blocked U.S. funding could arrive as early as next month. Dennis Shmihal spoke exclusively to Bloomberg a short time ago.
Nearest time, this month or maximum next month, we will have this good news from United States, and United States will join to European Union, to G7 coalition, military and financial support of Ukraine in this battle with Russia.
The $60 billion in funding is crucial to the nation's war effort, but has been held up by House Republicans in Washington. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the bull case for stocks.
I see large caps as safer until we start to see the Fed really
cut interest rates. Even if the Fed doesn't cut interest rates, there's still, relative health and relative gains.
That conversation up next, live from New York. You're watching Bloomberg Surveillance. Live from New York, 43 minutes away from the opening bell. Cash open just around the corner. Futures pulling back just a touch. Down 0.1%, just about unchanged. 430-ish on a 10-year, 428.86. The euro weaker, dollar stronger against G10 in a big way over the last week. Some dollar strength out there. And the surveillance this morning, the bull case for stocks.
I see large caps as safer until we start to see the Fed really cut interest rates. Even if the Fed doesn't cut interest rates, there's still, relative health and relative gains. The S&P 500 is now, a different animal than what it was in 2007. There is more high conviction bullishness on equities. Like I said, not all equities, but pockets. And I think those are the areas you want to watch.
Here's the latest this morning. US stocks at all-time highs ahead of the Fed decision. David Lefkowitz of UBS writing this. This support behind the equity market rally over the last year or so remain largely in place. At the same time, equity market sentiment and positioning has become somewhat elevated. So a modest pullback in stocks wouldn't be surprising. We would stay invested, but wait for pullbacks to add to positions. David joins us now for more. David, great to catch up with you, sir. You've got to define to me what a pullback is in this bull market over the last few months or so.
Yeah, a pullback is just, a modest decline in stocks, nothing we would necessarily call a correction, which is generally considered to be, more than 10% or so. We've just been in a pretty low volatility regime with a lot of good news priced into markets. And admittedly, I think the environment is pretty favorable as we were just talking about in the quote up there. But we also need to recognize that some of the sentiment, some of the positioning measures, they do look a little bit elevated. And, we're just saying, look, you just want to be a little bit careful about when you add to positions in equities. But overall, the environment remains good. We have a neutral allocation to equities in our asset allocation.
We're interested in what you would add to, and some of the sectors you like are similar to some of the sectors we hear a lot: healthcare, industrials, tech. I know you're interested in small caps as well. Can we sit on small caps for a moment? What is it about small caps? This is something that comes up repeatedly in conversations, that somehow, because of this narrow leadership we've had, we're going to rotate and small caps are going to do well after the dominance of mega cap tech in America. David, why is that the case?
Yeah, I think the case for small caps is look, at the end of the day, it's really going to hinge on if we see a pickup in earnings growth. So, if you look at the fourth quarter earnings season, all of the earnings growth in the S&P 500 came from the Magnificent Seven. But as we look out over the course of 2024, I think you're going to see the earnings growth story begin to broaden out. The banks are not tightening access to capital as much as they were. The high yield markets are open. We've seen a pickup in IPO activity and follow-on offerings. So the financing environment is getting better. Then on top of that, if the Fed does ultimately start cutting interest rates, that's just going to encourage this trend. And look, access to capital sort of drives the profit cycle. So I think you're going to see this broadening out in profit growth. The other thing to bear in mind is that the small cap segment, the biggest sector in small cap is industrials, right? So we've been in this sort of, almost goods recession for the last, a couple of years at this point. It looks like that's beginning to bottom. And so if we actually get an improvement, a little bit of an improvement in demand in more the good side of the economy, that would be pretty favorable for some of the smaller companies in the market. So there's a host of reasons, but I would say, crucially, it's just that we think we'll see a pickup in earnings growth, later on over the course of this year.
David, if the Fed has a hawkish message today, does that shift your conviction with small caps?
Yeah, look, I think we probably do need to see the Fed beginning to cut interest rates. That being said, I don't want to put too much emphasis on that, sort of that one thing, because I do think we're seeing financial conditions more broadly are easing. And that's really, part of the thesis here is that as you see access to capital improve, again, that should be driving profit growth. Fed cuts are going to be helpful for that trend, but it's not necessarily the most important thing.
What about other sectors? And this is something that we hear from a lot of people, is that because of this cyclical tilt, they like energy, they like some of the other areas like consumer discretionary, even at a time that people say we are seeing more discretion by consumers in terms of what they buy. Do you lean into that story? Do you think we're in the early stages of a bull market?
I think it's hard to say these are the early stages of a bull market. But look, I think there are some elements that are a little bit early cycle. But look, at the end of the day, we want to find where the best risk reward is. And part of the reason that we like the small cap trade, which we didn't really talk about, it's just that the valuations are so much cheaper and so depressed relative to their own history and relative to large caps. That's, I think, got to be part of the story. And then when we look at the large cap sectors, I think, we do like industrials, we do like healthcare, and we like tech. I think for each of these, though, you really need to drill in to find some of the best opportunities. In industrials, the transports area has been weak. We've had this freight recession. We think we're probably coming out of that, if not right now, in the next couple of quarters. That could be interesting. Healthcare has a nice, there's some defensiveness as well as, improvements in some of the areas like life sciences and tools, which have been under pressure. So, we're just looking for opportunistic places within the market, kind of regardless of where we are in the business cycle.
You're in the business of long-term wealth creation. If you'll entertain me, can we talk about a 6-hour time horizon? What is the risk reward of sitting at all-time highs going into the Fed this afternoon?
Yeah, look, I think the market is somewhat braced for a little bit of a hawkish message from Chair Powell. So if we do get, say the dots go to 2, which certainly is a possibility. I think the market is somewhat expecting that. Obviously, it's going to be important to hear sort of the timing of when they think they're going to start cutting interest rates. We're also going to hear about their plans for the balance sheet with the quantitative tightening, and when does that begin to wind down. So there's a number of different factors to watch. I do think, though, the market is sort of braced for a little bit of a hawkish tone. And so I don't know. I think it's going to have to be a pretty significant surprise relative to what seems to be the cautiousness going into this meeting for things to be quite negative for equities. But I think the big picture, I just think the big picture is that, look, the Fed probably will be cutting rates later this year, and I think that's the most important thing for stocks. The precise timing is I think, a little bit less important.
Well, the answer has just been later this year. David, thank you, sir. David Lefkowitz there of UBS on the Federal Reserve. We were promised a conversation about the balance sheet at this meeting, so look out for that as well. Let me share the lineup with you. Here's our lineup. Starts at 1:30 Eastern Time, going into the Federal Reserve decision, a special edition of Bloomberg Surveillance, The Fed Decides, joined by Kathy Jones of Charles Schwab, Matt Lazzetti of Deutsche Bank, Priya Misra of JP Morgan, Diane Swank of KPMG, Robert Tipp of PGIM Fixed Income, former New York Fed President Bill Dudley, Jeff Rosenberg of BlackRock, and Mohammed Al-Arian of Queen's College, Cambridge. Bramo, that is quite a lineup this afternoon.
To parse through all of those change projections or not and what the implications are, maybe we will hear Fed Chair Jay Powell come out and say, I was wrong, financial conditions matter, we're going to change the neutral rate to 4%. Most likely, probably not, but we're going to parse through everything that they put out there.
And then to react to all of that, tomorrow, here's the lineup tomorrow morning. Sebastian Page of T. Rowe Price, Cannon Pickering of Berenberg, Gargi Chowdhury of BlackRock, Stephanie Roth of Wolfe Research. There is a lot to discuss. The Federal Reserve decision, 2 p.m. Eastern Time, a news conference with Chairman Powell 30 minutes later. Live from New York City this morning. We'll see you this afternoon. This was Bloomberg Surveillance.